Hit it.
It's Friday, April 9th, 2021, episode 126. I'm Patrick Ceresna.
And I'm Kevin Muir. This week, we welcome Will Thomson from Massif Capital. We have a fascinating discussion about opportunities in off-the-beaten-path commodity companies, along with some other unique value investments he is making. Will is not afraid to name some tickers, so make sure you stick around. Then it's that time again. Kuppy is back, and he's starting a new position that will surprise you. After that, Patrick puts on the sorcerer hat for his talking charts segment.
And this week in trading history, we look back at the origins of Microsoft. We end with this segments of no stupid questions and skin in the game. And folks, we might even drink some beers along the way. So stick around. We got a great show. Lena, hop on. What are we drinking this week?
So today we're drinking Left Field Brewery's Squint Sunflower Seed Gose. Is that how you say it?
Goose.
I don't know.
I think it's Gose, but anyways.
What?
We'll find out. So the classic ballpark snack now in a beer, brewed with sea salt and Ontario malted sunflower seeds from Barn Owl Malt. Squints is puckeringly sour and refreshingly complex. Gentle salt, spice, and zippy acidity balance the unique earthy and nutty flavor of sunflower seeds.
I like it. I actually like it.
I actually like it as well, and it's sour, and I was like, wait, it's sour, but I like it? Like, what the hell?
But it is salty.
It's like chocolate and salt. It's good together somehow.
It says ballpark pairing, sushi sesame snaps. That's what it's supposed to be.
I like it. It's definitely the strangest.
I was like expecting to be punched in the face and was like, I don't know, but like no, I'm gonna. Well, let's see how we feel by the end of the show.
I think I'm gonna like it.
All right, why don't you give us some side effects, bud?
Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in the show. Side effects of too much Huddle may include itchy support lines, the silver smashes, or the chronic side effects deficiency disorder.
Wow,
that's
pretty serious.
Yeah, that's is one that I suffer. That last one is the one I suffer from all the time, so send them in, folks.
All right, let's get on to our first interview. We have a great pleasure to have join us today Will Thomson, which is the managing partner at Massif Capital. Will, great to have you on the show.
Thanks for having me, guys.
I've been looking forward to this, Will. It's Kevin here. When we were just chatting offline, you were telling me a bit about your background, and we do share the same kind of background in that we both had fathers in the business, but yours was a lot more interesting than mine. Why don't you tell me a little bit about how you kind of came to be in the investment or the hedge fund world and how you grew up with your father?
Yeah. So I guess, my story might be somewhat similar to a lot of maybe traditional value investors. My father worked on Wall Street. He was a floor trader, and then he was a market maker for a whole series of Wall Street firms, and grew up with him reading the Wall Street Journal and passing it to me to read something that he thought was interesting. And I don't even know when the first copy of Security Analysis landed in my lap, but it was probably a Christmas present or something at the age of 12. I think that a lot of people can, or maybe not a lot of people, but a number of value investors can sort of tell you that same story. I was lucky enough to get a job working in equity research when I was 16 for Bank of America. Worked for Bank of America every summer from 16 through to graduating college in their healthcare equity group and healthcare investment banking groups. After college, did the sort of usual investment banking and private equity thing that a lot of people do these days. And about 2008, 2009, the fund I was working for, the guy had been pretty successful, decided to shut things down, decided he didn't really need to deal with anything anymore. So I went back to grad school. And at the time, I had been sort of tasked with looking into student lending, of all things. And it was sort of an interesting sort of pursuit because I was looking at it, and as we were studying the industry, trying to figure out something we could do, the government sort of came in and changed the whole ball game. And I had found that particularly interesting. And so when I went to sort of look at grad school, I said, I could go get an MBA or maybe I can sort of find some way to study this sort of topic that was kind of interesting, like the government coming in and reworking an entire industry. And so I went to the government department at Harvard and proposed that they let me study political risk for businesses, which was something they hadn't had anyone come in and do. So I sort of crafted my own master's and focused primarily on natural resources projects and political risk for, companies working in emerging markets. Mostly that means sort of extractive industries, which is how I sort of developed an expertise in extractive industries. And then from there, I wrote my thesis on a couple of copper projects and natural gas projects out in Asia. Happened to write a couple of papers that were published on other topics, and got a job working for the DoD in Afghanistan, helping that country manage some of their corruption issues and helping the DoD think through some of the economic issues that the country was having. I would say that was probably my most interesting job, but maybe my least impactful, because I'm not sure anything I did really had any lasting impact. But I don't know, maybe not. We did write some natural resources laws while we were there, and it did facilitate the purchase of a large copper deposit by the Chinese. My understanding is that copper project is basically a large fenced-in area of land that'll never be developed. But I guess we'll see what happens.
You sold it, though. That was the important part.
Yeah.
Will, a lot of people come on this story, and there's a lot of great backgrounds, but I got to say yours is one of the most unique. Very few people convince Harvard to make a program for themselves. Before we continue, I just want to ask you a question.
Yeah.
Being the son of a New York Stock Exchange specialist, I used to make a joke when I used to have to trade against these guys. I used to say everyone wants their daughter to marry a doctor or a lawyer. I want my daughter to marry a New York Stock Exchange specialist. Because it was just I always used to just laugh because your orders would always go and they would disappear into the ether. And I realized that is my wife tells me that's a very sexist thing to say. I should be saying that I wanted my daughter to be a New York Stock Exchange specialist. So I will update that joke for the times. I have learned, dear Mrs. Macro Tours. But I was wondering, you must have had some great stories. Like, do you have anything you want to share? Like when your dad would come home and tell you stories about like a particular time, long-term capital, or 87 crash. Was he there? Like, do you have anything you can share?
Well, I will. It is sort of amusing. My dad, the 80s, so I guess there are two things. One thing that's sort of amusing for the present, and another that is a story. So the 87 crash, 2008, last year, my father is always on vacation when there's a big market move. So he was on vacation in Sea Island during the 87 crash. He was I don't remember where they were last year. They were out of town. He is never around for these things. I don't know what it is, but he is never around. And he tells me quietly, he's like, it is the great disappointment of his life, basically. He's never around for these major market moves. So I don't know what to make of that other than to say I'm always very cautious when he decides to go on vacation. But,
you put on the head just a little extra when he's on vacation.
Yeah. But I will say, he and I talk quite frequently. Obviously, he doesn't, he manages his own portfolio now. He doesn't manage outside money or anything, but he does have some interesting stories to tell, just sort of looking at the market now, trying to read the tape the way he used to. He says it's impossible to do. A lot of the lessons he learned, things have changed, and he is flabbergasted when he goes to try and execute a trade against these 100 share lot executions, and it is a very different world, and the plumbing and some of the regulatory changes that have occurred that have resulted in the high frequency stuff, a lot of the, let's call it democratization, I guess, of trading that has occurred. the market from his perspective, even looking at, say, level 2 and things like that, it's a very different market, he says. And he reminds me of it constantly. And he says that in his opinion, the value add of the signal that he can get from the market and watching it is not there to the degree that it once was.
That's very similar to what Stanley Druckenmiller has echoed in terms of the internal moves within the market used to give him signals about the economy and what was happening, and he argues that it's not as reliable as it used to be.
Yeah, well, I think my father would echo that sentiment. He's had to change his style a little bit, and continues to just have to evolve, which I think we all do. I think it's essential that we all continue to evolve. The markets obviously don't stand still, but it is sort of fascinating that just sort of market structure has shifted so dramatically.
So I'd love to talk to you a little bit about your graduate degree, because first of all, it's fascinating that you managed to convince him to make one. But not only that, I got to think that in today's environment, where I would argue we were about to go through a sea change in terms of attitude from the government in terms of actually executing policy that is going to change the business environment, it seems to me that you're probably pretty uniquely qualified to understand that and to deal with it. I just wonder if was this just luck, or did you actually see this coming?
Probably more luck than clairvoyance or anything. I definitely think it is helpful. I do. When I look at, say, the post-World War II era up until, 2008, let's call it, it was a period of time where, especially domestically, it seems to me that businesses were very much able to put a lot of the political sort of element of things to the side and to focus on, the business of business, if you will. Not needing to think about, say, political economy. They could think about economy.
Right.
And it does seem to me that is changing. And those trends, just like any other trend, there's some big long-term trends at play. And I think the return of politics and perhaps some sort of industrial planning type of thing in the West is going to come back with a vengeance to a certain degree over the next, let's call it 20 years. Whereas over the last 20, it's definitely taken a back seat. And that has been something that a lot of people have benefited from. And it has made markets a little easier to play, I think, but it's changing.
Okay, so let's talk about these big long-term trends that are at play that you see. I think one of the when I read your research and go through it, one of the big things is you make a real good hard case for real assets in the portfolio. Why don't you walk us through why that is and what you see, and then we can then go on from there about how you actually express it.
Yeah, so, I think real assets, again, you look over the last 20 years and we've had this great period of time to be investing in tech, and there's been a lot of benefits that have accrued to a lot of people and a lot of companies as a result of the tech trend. But over that same period of time, in the West in particular, not so much in China or India, the emerging markets can be a little different, obviously. But that is sort of come at the expense, if you will, of some of the investment in some of our more traditional businesses that still to this day form the underlying basis of the economy. And so I think we say on our website somewhere, the internet's great and all, but of course it runs on copper or fiber optic wires, and, your Amazon packages are still delivered in a truck that requires a highway and things like that, and steel, cement, concrete, etc. So these real assets, not only are we due for a significant reinvestment or period of reinvestment into these real asset industries. But in the developing world, they're coming up in many places as China sort of has just gone through theirs to a period where a lot of countries are needing to invest in these real assets. And as as economies grow, the demand and the call, if you will, on natural resources continues to increase. There's sort of this question of whether one can decouple the economy, let's say, at any time ever from natural resources. And the majority of research shows that you can't decouple the economy from its natural resource use. And so natural resource use and real assets, the use of them just continuously increases as the economy grows. And so we look at the market and see a lot of focus on biotech, a lot of focus on information technology, technology in general. And admittedly, these are great places to be focused. But if you want to look someplace where very few people are paying attention, it's in the real asset sort of economy. And that, from our perspective, is a lot of the energy economy, which parts of it do attract a lot of attention these days, but other parts don't. It's the materials, and materials, I would say, is probably the sector of the economy that attracts the least attention relative to its importance, in my opinion. And then various different sort of heavy industries. All of this real asset ecosystem has been out of vogue and out of focus. But as we move forward, as the economy continues to grow, and as we attempt to address some climate change issues, that real asset ecosystem is going to be significantly disrupted and change quite dramatically. And in that change and disruption is a significant opportunity.
So why do you think this real asset industry or kind of investment theme has been out of vogue? Like why was it forgotten?
I would say it's because they're slow moving industries that don't change very much. You look at steel manufacturing, or you look at cement, you look at mining. Most of these businesses, the businesses themselves haven't really changed in 100 years. And we're only now, with climate change, with this sort of outside event that's prompting companies to think about real hard science R&D, about how to change their business models and how to go about improving operations. You look at something like the steel industry, and information technology can certainly help their businesses, or the steel business or the cement business. Okay, but the reality is that it's really hard science that is going to change and upend these industries. And most of the hard science, most of the engineers, most of the the tech people, they've all gone into software. But now we're being confronted with challenges that require sort of change in the real world. And so now there are industries that are being disrupted. And so now they're sort of becoming interesting once again to look at.
And not only do we have that kind of out of vogue with the real assets, but this is also coupled with a change with the ESG concerns. And I know you've written some interesting things. Why don't you kind of put a lens on how you think ESG affects this and what investors should be thinking about when they're looking through that lens?
Yeah, so from our perspective, ESG, I think it's important to separate just sort of like there's ESG, the marketing instrument, if you will, that Wall Street is trying to sell everyone. So BlackRock, your ESG ETFs, et cetera. This, from our perspective, and we've written on this and we've spoken with Jim Grant about it and a couple other people, that marketing stuff is, well, it's just that. It's mostly marketing. You look at an ESG ETF, it's going to track some index, the S&P 500, let's say, and that portfolio is really not going to be any different than what you get with a regular S&P 500 ETF. There'll be some slight reweighting of things, but not terribly significant. If you invest in an ESG ETF, you are mostly allocating capital in a way that, hopefully, at least from the investor's perspective, will do no harm, but it'll also probably not do any good.
Okay.
The way we tend to look at it is we tend to think about economic and environmental sustainability. These are sort of two sides of the same coin. And if what a business is doing is not economically sustainable, obviously that's not of interest. But if it's not environmentally sustainable, the window in which a company can act in an environmentally unsustainable way is rapidly closing. And so they are quickly becoming two sides of the same coin, where as a management team and as a business, you need to be able to present your sort of plan for achieving environmental sustainability while at the same time achieving economic sustainability. So that tends to be how we look at it, which again is another reason why we think the real asset universe is interesting, because all of those businesses have been operating in a environmentally unsustainable way for the past 100 years and need to change and figure out new business models such that they can become environmentally sustainable while maintaining their economic sustainability.
Okay, so could you give us an example of a company that does that sort of production or mining or whatever it is, and has actually managed to make the shift and is something that you're invested in?
Yeah, so we tend to think about, we break sort of companies in this world up into two buckets. We think about the companies that enable the transition to a low carbon economy, and those would be things like a copper miner, or transitioning companies. And those are the businesses we're sort of talking about here that actually need to change what they're doing. Okay. And there's going to be an ebb and a flow between those two sort of types of businesses about sort of what's a viable investment over the next 20 years. And at the moment, the transitioning firms, there aren't that many of them. And the reason for that, again, comes back to the fact that, in order to transition the steel business or the cement business, there needs to be some very fundamental science, because the processes they employ are what actually cause carbon emissions. Okay. And if it's the process, you need to come up with a new process. And of course, coming up with a new process to make steel or cement or some chemicals is quite difficult and time consuming. So the best example currently of transitioning firms is a lot of utilities. The utility transition is the lowest hanging fruit in all of sort of climate change. The best examples, at least in my opinion, are often in Europe. We are invested in a company right now called RWE. Okay. RWE is one of the largest utilities in Europe, and it was the largest coal burning utility and also the largest nuclear power operator. What they've done is they have purchased the renewables pipeline from E.ON and they've actually swapped it. It was an asset swap, not a purchase, and given E.ON their distribution assets and built out a pipeline of renewables, offshore wind, onshore wind, solar. And as they phase out the coal, they'll continue to operate the coal till about 2038. And take those cash flows, though, and they are recycling them into an ever-growing portfolio of renewables. There are a couple of nice things about this. First of all, the margins on the renewable assets are quite a bit higher than the margins on the coal assets. So over the sort of last 10 years, RWE's EBIT margins have been sort of around the 4 to 6%. With the switch over to renewables, they've bumped those margins up to more like 15%. Additionally, they're signing, long-term 30-year offtake agreements for their electricity. So you have tremendous clarity and insight into future cash flows over time. And so not only in this shift have margins expanded, but the ability of you as an analyst or an investor to gain conviction about what forward-looking earnings and cash flow appear to be is quite a bit higher. And so this transition not only reduced the carbon footprint, made them more attractive to, say, some of those ESG marketing flows, but also just improved the business overall.
The other thing about RWE that I think is interesting is I was watching something, or I can't remember where I stumbled upon it, and they talked about the European carbon market, the emissions, and it's one of the most active carbon, or I guess is it a credit? Like what is it?
It's an emissions trading scheme. So the exact details of it are it's quite confusing.
Right.
But at a very high level, basically what you've got is everybody gets some carbon credits. Everyone who emits carbon in Europe gets some carbon credits. And if you don't need to offset carbon, you can then trade your carbon credits. If you
Right.
need to offset your carbon, you use your carbon credit.
And I think it's a little bit like through these credits, they're going to reduce the supply and thereby reduce the amount of carbon in the atmosphere. But what's interesting about this is that RWE, I believe, is long tons and tons and tons of these things. They've bought just a huge whack or somehow have gotten it. So if you're interested in that market, and it is something that I know some hedge funds have been looking at, it is actually RWE is one of the interesting ways to play it. So it's nice to know that not only do you get that benefit, but then you actually think from a fundamental basis that the company is actually also worth looking at.
Yeah, no, it definitely is, and they have. I think they've hedged out all of their carbon emissions with carbon credits through to the end of 2030. It might be slightly off with the dates there, but that's something along the lines of what they've done. And as the carbon market has evolved and as the EU has brought down their sort of emissions targets, the number of credits available has been sort of decreasing. And as that decrease occurs, the prices have gone up. And so they've really, the credits have, I think they may have doubled basically.
Yeah, it's been a terrific performing, and there's futures on it. So I know a lot of hedge funds are kind of becoming interested in the market. Okay, So we talked about the two buckets. This is the one bucket of a company that's transitioning from being dirty to clean. But then you have a whole bunch of other companies that are actually producing things for this new kind of clean economy. And I assume that that's the majority of your investments. Why don't you walk us through, a couple examples there?
Yeah. So at the moment, about 55% of our portfolio is outright in mining firms. So it very much is the largest bucket for us, these enabling firms. And a good example might be something like Lithium America. It really is a great example of the type of firm we look for in general. Okay. So Lithium America is a pre-production mine. So there are a lot of different ways to invest in mining firms, a lot of different points in a mine's life cycle to invest. We like to invest in sort of post-geology, but pre-production. So you can invest in a mine when it is just a geological discovery. We have found that to be exceedingly challenging and requires sort of a tremendous level of expertise that we don't possess. We're not geologists, so we don't have that expertise. But one of the interesting things that happens to mining firms is after there's a discovery, the stock pops. And then people sort of say, oh, it's going to take 5 years. We've had a nice pop. They got to permit this. They got to finance this. Let's get out. And so you get very much like biotech companies after they make a discovery, you get a pop and then you get a sell-off. And then there's this sort of valley of death while production and development, or while development is occurring en route to production. And that's when we like to invest. And we like to invest there because basically what's happening is the project is being de-risked and tends to trade down as it's de-risking. So, you're lowering your risk while you're investing, and then it comes into production. Now, there are issues with developing a project, but they don't, generally speaking, come out of the blue. You can, you sort of know what types of issues multi-$100 million to $1 billion infrastructure like projects have. So, but Lithium America is they've got two deposits, lithium deposits, one in South America, one in the United States. The South American asset is called Kuppy. It's going to turn on. They had some delays last year due to COVID. It's looking like next year. It is a brine deposit, low cost. They have pre-sold 100% of the offtake to their partner in the development of the project, a company called Ganfeng, which is one of the larger Chinese lithium companies. And then their Nevada project is called Thacker Pass. And what has happened is, sort of lithium has caught a bid again. Everyone's got excited about EVs, and Lithium Americas took off, and management took an opportunity to issue stock at an all-time high, and basically finance the construction of Thacker Pass, which will be the largest lithium deposit in North America, probably for the next 40 years. And they've managed to sort of finance it. It's now permitted. And so Lithium Americas is very quickly approaching the point where they are going to go from a pre-production junior mine to one of the 4 or 5 largest lithium producers in the world at sort of a critical time for lithium.
Right.
So it sort of is a good example of what we look for in an enabling firm. Someone who's got fundamental catalysts, but also has that commodity tailwind. So we don't want to ever bet just on commodity price direction, but if we can bet on sort of a company with fundamental catalyst that has a commodity price tailwind, we're going to do it.
You're in terms of who put me on to you guys, it was actually our good friend Harris Kupperman, and he said you'll never meet anyone that knows more about a stranger group of commodities than Will. So why don't you talk to us about these different commodities? Like you mentioned EVs and lithium and this new play that is hopefully fixing it, or at least, taking advantage of this new demand from EVs for these good commodities. What other commodities do you see being bid out there, and how do you think this all plays out in the coming years and decades?
Okay. Well, let's see. What else? Well, since you said a strange group, I'll toss out a really strange one. We just took a position in a company called Alpha Min Resources.
Okay, what's this? Oh, by the way, the symbol for the last one was LAC on the American Exchange. What's the symbol for this one?
Alpha Min is AFM on the TSX.
Oh, okay. It's a local one. Okay.
Yeah. Alpha Min is a tin miner in Africa.
Okay.
So most people probably don't even think about. I mean, do you guys know where tin is used?
You know what? I'm not. No, I'm not going to even pretend like I know.
Okay, so tin is used in everything, basically, but only in very small quantities. So if you pull out the motherboard of your computer and you flip it over, and you see all those little dots on the back of sort of a board that keeps chips in place, the solder, that is all tin. Okay. Anytime, electrical wires are connected, there's a little bit of tin. And so the market is very small, but obviously it's a critical market because it is sort of this glue, this metal that acts as a glue to keep everything together. And what has happened over time as sort of electronic devices have proliferated is that the tin market has gotten tighter and tighter, but it is still a small market. And so there's been very little investment. And that's one of the things we're always looking for. We're always looking for a market where, there hasn't been a lot of investment. So we like to focus on the supply side of things because that's sort of something we can say, okay, how many mines are out there? How much are they producing? What is current demand? We don't want to try and forecast future demand too much because it's just so hard to do. But supply we can think about, right? Because sort of the rate at which mines produce, how long it takes to bring on a mine. And so the tin market, Alpha Min is the first tin mine that's come online in, 20 or 30 years. I'd have to double check exactly, but it's something like that. It is also the highest tin. It's got the highest tin grade of any mine in the world, and so tin is also used in all renewables. So you flip over a solar panel, there's all kinds of tin in it. Wind turbines, not quite as much. It's also heavily used in advanced robotics. So you've got this interesting niche metal. You've got the highest grade mine in the world, and you've got no coverage or anyone paying attention to it whatsoever. Meanwhile, the price over, say, the last 12 months on the LME has gone from something like $15,000 a ton to about 26, 27 on the way, I think, to probably 30,000 per ton. And so over that time, Alpha Min has mostly traded sideways. And, look, it's a small little company, couple $100 million in market cap, niche metal, Africa. So it doesn't necessarily have the catalyst or the ability to attract the attention that some other metals might, or as a company attract the attention that other companies might. But if you're looking for just straight value, a company that is producing huge cash flow on a single asset and is going to return that cash flow to shareholders, then Alpha Min is sort of the place to look.
There you go. There's the high octane one. Okay, let's talk a little bit uranium, because I think you have an interesting take on uranium that is not something I see every time, very often. I see you even said you kind of shat all over our beloved Cameco, but that's fine. It's what makes the market. Why don't you tell us what your opinion is on the uranium market and why you went with the big Russian name?
Yeah. Well, so we went with Kazatom. We are investing in Kazatomprom, which is a Kazakhstani company, not a Russian company.
Oh, I'm sorry. Yeah, okay.
There is that important difference.
Okay.
But I think, look, I've followed the uranium market for the better part of 10 years, and I mostly avoided investing in it at any time because I didn't see an opportunity to deploy capital that wasn't just sort of sitting there waiting for the uranium price to move.
Okay.
And again, as I sort of mentioned before with Lithium Americas, we're looking for a fundamental catalyst as the primary driver of returns, and the commodity price as a nice tailwind that'll create momentum or something. And so looking at the uranium market, you had Cameco, big producer, and then you had a lot of juniors for the last 10 years, who some of which have great assets, world-class assets, next gen, Arrow deposit, world-class asset. But, they weren't going to put these assets into production. Well, they weren't even going to put them into development, let alone production, until the uranium price moved.
Right.
So you put your money into them and you've been sitting around waiting for the uranium price to move. And so from our perspective, that sort of comes with a significant opportunity cost. Kazatomprom came along and went public in late 2018, 2019. Dates are a bit blending together. And they were going to pay anywhere from a 7 to 10% dividend right off the bat. They were capable of producing uranium at $14 a pound when it was trading at more like 22 or 23 when we initially invested. Now with uranium at 30, they produce plenty of free cash flow. They always have produced plenty of free cash flow. And in going public, management was quite explicit about wanting to shift from a business model where they had primarily focused on volume of production to a business model where they were going to focus on, sort of the return on a pound of uranium produced. And so that shift was not only good from the market because they were going to take supply offline, but also good from the perspective of an investor. And so our thoughts were, well, look, we can invest in Kazatomprom, which we think is, we invested at about $13 per share.
Can I just interrupt there, Will? Do you buy the ADR? Is that what you do? Or did you actually buy it on the, I see when I'm pulling it up here, KAP on the London.
Yeah, we own it. We own it in the London, the London.
Yeah, so it's the ADR. So that's the one. So, okay, great. You can continue. Sorry.
And we sort of sat back and said, well, the setup for uranium looks great. The setup for Kazatomprom looks even better. Because here they are, we're going to get some potential capital appreciation because this has got to grow into a fundamentally justifiable valuation, which is about this $30 range it's at now. And they're going to pay us a dividend of 7 to 10%, which these days is a good, strong dividend, to sit around and wait for uranium to pop and for that to impact the stock price even more. So, people have invested in various different Canadian juniors and, that money's been sitting on the sidelines. Admittedly, over the last 6 months, they've moved a lot, even though the uranium price in the grand scheme of things hasn't really moved much. I think it's even harder to invest in uranium now, given where some of these juniors have moved to, given that none of them have advanced their projects at all, really. And just sitting around waiting for the uranium price to move seems like a bit of a fool's errand, in my opinion.
Have you ever seen a market where the producers actually have taken to buying back the spot, which is what's happening now?
No.
It's shocking to me that this is where we're at.
Yeah, people have asked me that question. I have not. I couldn't come up with an example. I looked through a couple of different sources I've got trying to find an example, and I really couldn't find one. It's a bit of a wild market, that's for sure. And it's an opaque market, but I think that from an investor's perspective, the more opaque the market, the more opportunity there is for you as an investor to add value with research. It's really hard to have a differentiated viewpoint, let's say, on iron ore, right? I mean, iron ore trades huge volume. It's got huge number of eyes on it. It's hard to have a differentiated viewpoint. But uranium, you've got to dig. You got to talk with people. You've got to, sort of get out from behind the computer screen and add some value. So we like that.
Okay, so I'll let you add some more value. One more dealer's choice. Give me another name you like. It doesn't need to be uranium. You pick anything that's interesting that you kind of think that people should have a look at.
Well, I'll give you two. We'll go political risk heavy this episode.
Okay, sure, sounds good.
We did Alphamin, which is the DRC. RWE, Germany, Europe. There's not a lot of political risk there per se, although maybe. But we'll go to Ecuador now and talk Lumina Gold and Cornerstone Capital. Both of these are interesting, what we would call asymmetric return positions in our portfolio, and they're a bit binary because they're both about a sale of an asset. So Lumina Gold is a spinoff from a series of Ross Beatty-backed companies. They have a gold deposit in Ecuador, one of the top 20 largest undeveloped gold deposits in the world. And they are looking to sell it sometime in the next 12 to 24 months. Should the mine be developed, it's got a sort of net present value of probably, I think we usually put it at around $3, and you can buy it at around 80 cents these days. Cornerstone Capital, this one's even more interesting in some regards. Cornerstone Capital is a prospect generator of sorts. They own 15% or so of Sol Gold's Alpaca copper project, which is one of the, probably one of the great copper deposits that's going to be developed into a mine over the next 10 years. They picked up an ownership stake in the asset when it was sort of on the trash heap. Sol Gold came in and set up an earn-in agreement with them and earned 80% or 85% or so of the project. Cornerstone retains 15% of the project and owns 7% or so of Sol Gold itself. And our math, looking at the deposit, if you assume copper in the ground trades at around 7 cents a pound, which sort of historical transactions imply, you're looking at sort of like a $12 per share value for the assets that they own versus the current $3.70 share price.
Okay, can you give us both symbols?
Cornerstone, Lumina Gold is LUM, and Cornerstone Capital's ticker symbol is CGP.
Okay, and those right. Lumina Gold is on. It's another Canadian.
They're both on the TSX.
Yeah,
sorry.
Even though we didn't plan this, folks. Yeah, Will's actually from North Carolina. Lives in North Carolina. It's not like he's. Just seems to be that he likes Canadian names.
Well, we got to go somewhere for the mining firms, right?
Yeah, or maybe it's the political risk you're looking for.
Yeah. Both of those we think are interesting. Admittedly, though, they are quite binary, right? The assets get sold, they get sold. They don't get sold, you're sitting on the stock for a long time. So, those are interesting as, at least in our opinion, we haven't necessarily scaled them to a full size position. We're going to keep them in our book. That means they're sort of about 3 or 4% positions. And that's just because they're sort of that single catalyst and they're either going to pop and work really well or they're not.
Okay, so I'd love to talk a little bit about your portfolio management, how you go about allocating, and walk us through in terms of when you're thinking about how you construct a portfolio, what you're doing, how it works, and just kind of what goes through the back of your mind.
Yeah. So, I mean, it's obviously a little different than perhaps some of your listeners might be looking to do for their own portfolios, because we manage money sort of professionally for outsiders that expect, annual returns, et cetera. But generally speaking, we think of trying to have roughly equal weight in both or in energy, industrials, and materials. Admittedly, we're vastly overweight materials at the moment, but that's due to the opportunity set. And then we think about trying to create some balance between the asymmetric return positions, which we think of as something that can return in excess of 100% over the next 2 to 5 years, and these ballast positions, which we look to have sort of a dividend and capital appreciation of sort of up to 100%, but they should be much slower moving companies, something like Equinor, for example, on the energy side, or RWE for that matter. Bit more, ballast. It's not going to, Cornerstone's either going to work or it's not. RWE is probably not going to be an either work or not work. It might not pay off, but it's, they're not going out of business or anything.
Sorry, I would just want to jump in and ask, like, when you have a stock like how do I say,
Kazatomprom?
And it's almost doubled on you, and it's close. It's approaching your target, and you think it's, you mentioned 30 pounds. I guess it's trading in pounds, and is that something you're going to be selling and redeploying, or are you generally one to let it run? Like, walk us through the kind of the process for taking profits.
Yeah, so Kazatomprom's a tricky case, and we have this problem every time with companies like Kazatomprom. We have a lot of them. How much commodity price momentum are we interested in trying to collect is basically what the question has become with Kazatomprom. How long are we happy to just collect let's call it on the low end, a 7% dividend, and sit on this capital appreciation while we wait for the uranium price to move? Our thesis was in many regards sort of built on the idea that we would get capital appreciation and then sit and wait for the uranium price to move. So we will probably trim Kazatomprom from the 10 or so percent position that it is now and take it back down to maybe a 6% position, and redeploy that capital into something that has, basically high grade the portfolio, something that has a higher return potential, because in many regards, the Kazatomprom opportunity is a bit of an unknown, right? We know if uranium moves, Kazatomprom will move, but how much is it going to move? Well, we don't really know, right? It's the largest holding in the two larger uranium ETFs. So maybe it moves a lot because maybe everyone decides uranium is something they've got to have. And the easy way to do it is just to put money into a uranium ETF. So maybe there are a lot of flows and maybe it really pops. Maybe it doubles. But maybe it doesn't. Maybe uranium only goes to $40 a pound, sits there, and we get another $10. But because we have a situation where we know what the likely outcome from a probabilistic perspective is going to be, but we don't really know what the return potential is, we want to pull back a little bit on the sizing of that position. Now, because there's a dividend, we don't need to pull it back quite as much per se as we might with a company that pays nothing and we have no return on capital. But we are definitely going to pull it back. And so we think about things in sort of probabilistic scenarios. Now, admittedly, those probabilities are subjective. We just come up with them based on a conversation between my partner and I. But, we sort of have this high price target for Kazatomprom of $50. We sort of put a $40 probability on that, or a 40% probability on that. And then our base case is a $30 valuation with a 50% probability. And then we have a low case, 10% probability. That produces, an unadjusted probability weighted value of about $35. So we can continue to hold it. But we just sort of need to be cognizant that over time, the annualized return is continuously decreasing, and because of that, we need to sort of tighten up our portfolio management and sort of our exposure to that asset.
I get it. So how big would you let a single position become?
We our guardrail is around 15% of the portfolio.
Okay.
And so Lithium America, for example, bumped up against that recently. We do try to manage some of that with options. So we'll sell, something like Lithium America, it gets up to 15%. We know we want to take it back down to whatever, 12% or 10%. So we'll sell covered calls to try and manage around that when we can. If we can't, we'll just trim the position. And that's sort of how we manage it.
Okay. In terms of, let's go back to the political risk and my original kind of point that I said that I felt like we were approaching a time when the environment was changing. Do you agree? And if so, like when you think about individual investors, do you think that this is a time of opportunity for them like that we haven't seen before? Or is this just another cycle along the way?
Well, when you say an opportunity for them,
in terms of, are we on the cusp of a change of the political environment, which will result in more changes than usual in the markets? So, for example, we're seeing a government that is much more willing to go and put in place programs like spend more. We've had deficits like we've never had before, and it just seems to me that it's a much more activist government. And so when I look at that, I say, well, with a much more activist government that's trying to accomplish more changes in our society, you have to agree that, whether you believe in it or not, this government is trying to change societies more so than any government that we've had probably in, many decades. So with that, does that just bring about more risk, or are there also more opportunities? I would love to know your kind of feeling about that. Or is this just, to you, it's investing and we're just, it's another cycle. It's another little spin on it. And it's just Wall Street making a big deal about, trying to sell stuff.
Yeah, no, I don't think I don't know if it's going to be huge change, but I would say the following. Whenever you have the rise of a revisionist power, and I would call China a bit of a revisionist power, that confronts the existing establishment and says, we want to do things differently, you're going to have tension and conflict. And conflict doesn't necessarily, I'm not talking about a war here necessarily. I mean, that's possible, but that's not sort of what I'm talking about. You're going to get a lot of disruption. And I think what we've seen, especially since the Trump administration, is a shift in the mindset in the United States and in Europe about how not only what China is to the world, but how best to confront it. And some of that question of confrontation or how to address it has very much been to look at China and to say, what have they done that has succeeded? And you see in Europe a rollout of industrial policy, especially with this sort of their Green New Deal. And to your point, you see it here with the Biden administration, a bit of a rollout of, more economic planning. And so there is this degree to which we've looked at China in some regards and said, we kind of want to take a little bit of what they're doing and apply it to our model and our system and see if we can't outdo them. And that's going to create, opportunities. It's going to create risks as well. But I think political risk is quite an interesting risk because the first thing you have to recognize is that there's geopolitical risk and then there's sort of political operational risk, and they're very different. And political risk is very much a person risk. It's about whether a management team can interact with a government and a society and its people and sort of get what they want out of it. And some management teams are quite capable of that, and other management teams aren't. And so there's this new or additional layer to think about in terms of your assessment of management teams. Are they good political operators? If you are a good political operator, the last 20 years have been good to you. I think the next 20 are going to be even better. Now, is that a good thing for society? I don't know. But, I'm, as investors, at least in my opinion, we're, surfers or skiers, right? The wave is the wave and we're going to ride it. It's not our job to sort of try and shape the wave. That's a politician's job or something. So whether that's good for society or not, I don't know. But I do think the next 20 years will be very good for management teams that are skilled in their political operations.
Okay, so Will, I'd like to end with a couple of questions that I'll throw out at you. First of all, your father gave you a lot of books. So you mentioned that you dropped off, on your bedside there to read. What do you think? What was your favorite, one or two books about investing?
So I guess I'll pick a couple of more obscure ones that I thought were helpful. There's a book called Excess Returns, which is by Friedrich van Haverbeck, who's like an engineer. This is a great book about investing. It's sort of an engineer's approach to value investing. Guy sort of sat back and said, I don't know anything about investing. Let me just sort of study it. It's a great book. Then there's this other book called The Art of Execution. Something I've found that's quite interesting is, you want to learn about how to value a business. There's like endless books you can read about valuing a business. There's no end to the number of books about how you value a business. But there's a lot more to investing than just valuing a business. There's how you actually execute the idea in the market. There's how you manage the portfolio. And outside of some of that, efficient market, MBA portfolio theory type of stuff, there's not a lot written about that. This book, The Art of Execution by Lee Freeman Shore, I think is quite good and quite useful for investors.
That's awesome. Two books that I'd never heard of. I'm going to put them on my list. Okay, last question. If you were to meet your Will of, let's just say you've just finished high school and you're about to head off to university and you're looking for some advice about life, what advice would you give him? Okay, I'll give you another one. If you're meeting someone today that's very passionate about the markets, really interested in stuff, and you were to say, and they say, I'm just finishing my last year, or I'm in my last year of university, what advice would you give them?
Do not go into investment banking. Everybody laughs, but where do these high flying type A personalities who want to go into hedge funds or something, where do they go? They go like McKinsey route into consulting, or they go the investment banking route. Neither of these routes, in my opinion, is a good route. You should go into an actual business. Go see how an actual business operates. Go off to India and work for a charity. Do something other than finance that gives you some experience of the real world to bring back to your investing. People say, go to investment banking so you learn some of these like DCF skills, how to work your way through Excel and whatnot. That stuff it's not that it's unimportant, it's important. but you can learn it on YouTube. And, anyone can put together a DCF model. It is not hard. It is not complicated, and everyone learns it. So in that regard, it's kind of useless. If everyone knows it, it's kind of useless. So go off and do something that nobody else is doing and produce a resume for yourself that is different. I would also say everyone should be writing a lot more. I think that, my career, I've written and published throughout my career. And I would say that almost every single opportunity I've gotten has been as a result of something that I've published. And in this day and age with the internet, there are so many different outlets for you to publish on some sort of topic that you're interested in, that we should all be taking advantage of it. And when I say publish, I don't mean like a tweet. I mean something long form that you've spent some time thinking about. And the opportunities that get thrown up as a result of that are just tremendous.
That's some great advice. It makes me laugh. It's got to be more than a tweet. Okay, so where can people find out more about your firm and what you write and learn more about, getting some of those great reports?
Yeah, our website is the only place we publish. I think things get picked up at various different places, but our website is massifcap.com. We do have a Twitter account, although it's just sort of an automated thing, or every time we publish something, a tweet goes out. You can also look me up on LinkedIn. I'll connect with most people, and we publish stuff there as well.
I just want to, highly recommend that. I love your website. I love going through your reports. It's obvious you're a terrific writer, and it's really enjoyable to find someone putting that out there, and I really appreciate it. Thank you very much for coming and spending some time with us.
Well, thanks, guys. Great to join you.
Take care.
All right, it's time for that once a month segment that everyone waits for. It's Kuppy's Corner. Kuppy, how you doing, buddy?
Doing great. How you guys doing?
Oh, we're doing great. So many things to talk about, man. Okay, I want to hit you up first on this Playboy. Wow, is all I have to say.
I told you guys. Did you ever get any of it?
No. I feel shame.
Man. How can you not buy Playboy? Pretty girls are always in a bull market.
So how do you play it from here now?
You don't.
You just get out? You're out?
Yeah, I'm all out. I have some puts that are left. I wrote some puts. They're just burning away. I don't mind getting back long if I get assigned. But no, I'm basically out. I mean, look, it was a double in like 3 months or 4 months. You don't get too many of those. I mean, it's kind of funny.
Yeah.
Like, I think we talked about this in the show, and no one cared that it was trading at a single-digit multiple while growing really fast. And then they press release that they have this non-existent NFT business. Everyone got super excited, and it tripled.
It was nuts. Like from last month, the thing was like $10-12, and like what a run just in the last 2 weeks, like from 16 to 34, right?
NFTs, it's crazy. I mean, in the end, when you're long equities, you're really just long volatility of some type, and sometimes something comes out of the blue, and you just get lucky.
Right.
But anyway, happy, gone.
There you go.
Victory.
Well, congrats. That's awesome. So now the reason I'm going to continue this conversation is because Kevin's not allowed to talk about this. So I had to ask you, like you were all over Twitter there that you're exiting your Bitcoin trades. So what's your thought process here?
You know, the trade from 9,200 up to about 60,000. I mean, big 2-year base. It broke out of the base. It just ran. FOMO took over. You had all these QSIPs buying it. The grayscale and all the other acronyms. And we talked about this a few times. It was one of those great layup setup trades that you only see a few times in a career, where you could play it really big and just know you're going to be right. So I won, and I don't know, the last week or two, I'm looking at this and saying it's a 6-bagger. What's going to happen next? And honestly, I have no idea. My gut feel says it keeps going higher just because Project Zimbabwe and all. But, there's a lot of things that you could buy out there that are pretty low risk that could be doubles and triples. And I don't know, is Bitcoin going to double? That'd be a 2 trillion market cap. Like, trillion market cap assets don't usually double and triple again. So I just decided to ring the register and declare victory.
Well, it's still very much in trend. I still think that it's not out of line technically for it to even make a punch towards 70,000. But I agree with you. I don't know whether it's a double from here at this stage. I mean, it might catch one more wave in there. But now that we're leaving Bitcoin alone, maybe Kevin might want to come in here and ask something.
I only have 4 words to say for you guys.
Have fun staying poor.
Dude, have fun staying moderately wealthy. I had a 6-bagger.
Just kidding. Okay, let's talk about some serious things here, Kuppy. Your new kind of trade is you're looking at the reopening plays, and you have some interesting takes on it. I'd love to go through and hear what you're thinking and how you're expressing this view.
Yeah, I mean, look, I think the reopening trade, it's this thing that's just gotten away from itself. I mean, look at the cruise lines. They have no revenue. They now trade at 2 times the enterprise value that they traded at before COVID happened, back when they had revenue and cash flow. Look at the airlines. I mean, they're bleeding money. A lot of these things are 2 and 3 times the enterprise value back when, they were actually making money at this. People have been so all over this reopening trade. These things have gone to crazy stratospheric, multiples that make no sense, I think.
Okay, but you've managed to find something in terms of a way to express this that you feel the market is missing, right?
Right. I mean, leave America and leave basically the U.S. capital markets where all these people are focused on this and pretty much go anywhere else. I mean, I put together a list of, hotels, casinos, good assets that I'm absolutely sure that 22, they'll have good returns. 21 is probably a transition year. But you look at these things, you could buy them at 10 and 20 cents on replacement value. No one's building any more casinos right now. They're not building new hotels. So, you have a capacity kind of winnowing. A lot of guys went bankrupt. I think they're going to have great years. You could buy these things at 10, 20 cents of the dollar. A lot of them are down 50 to 75% from the highs. I think the trade really is to short the U.S. ones and go buy some of the overseas ones.
Well, I find this fascinating, Kuppy, because when we were talking earlier, I was telling you about a very popular trio that they do what they call social arbitrage, and they look at the trends in the social environment, and then they go ahead and they buy stocks based upon that, and they're big all over this PLTY. I can't. How do you say it?
PLYA.
Oh, Oh, that's right. You got it better than me. So this is their big pick, Playa Hotels, and when I asked you about it, because it seems very much in line with what you're looking at in terms of its hotels. It's based upon increased let's just say usage and people getting out and doing things, and you're both seeing the same things, but you're coming to a very different conclusion, and you're expressing it in different ways. What makes you not be attracted to a PLYA and go find some other names?
Sure. I mean, you guys are going to hate this, but let's put our efficient market hat on for a second. So, yeah, I know. I'm going to regret saying that. Yeah. But look... So Playa Hotels, okay, it's a 1.2 billion market cap. Right before COVID hit, so let's look at this in December. It was a $7.50 stock. So December of 2019, $7.50 stock. At the lows, they had a fire sale of assets because they ran out of money. Then they issued equity. They issued 40 million shares at about $4.50 average. So, if it was efficiently priced at $7.50, and then they sold a bunch of assets on the cheap, and then issued a bunch of shares at about half of fair value, the efficient market would say that it probably should go back to, $5.50, $5, somewhere around there. I mean, they've just lobbed off, a lot of the value of the company, and that's before you even include all the retained losses they had over the past year, which is a big number, quite honestly. It should be $3, $4. And it's not like these guys are printing money. I mean, look at Q4 results. They lost a ton of money. The reopening trade is kind of a let's hope for 22 thing. They might not even make money in 21. Yet here we are. We're back at $7.50. It's almost like this didn't even happen. It's almost like they didn't fire sell hotels or dilute. They went from 120 to 165 million shares. Like, I don't get it. I mean, this stock should be $3, $4, and that doesn't even, that's just the efficient market, not even including next year's losses.
Well, I think we've all seen that the efficient market isn't so efficient lately. So can you share with us some names that you think do offer better value down here?
Yeah, let me throw one at you. And I'm always hesitant to throw, smaller companies, but let's just do this because it's fun. Company's Hotel City Express. It's a Mexican hotel chain. My wife's Mexican, so got to throw out the Mexican one. Stock was about December of 2019. We're looking at 15 peso. These are pesos. Today we're at 6 pesos. So, it's down quite a lot. You can look at a chart. It literally hit the floor at 5.5 and has not come off the floor at all. They've lost some money for the last year, but they were able to keep their losses pretty restrained. What makes it interesting is that I thought it was pretty cheap at 15 pesos, quite honestly. It's a rapidly growing hotel chain. And the thing about when you are growing very fast and building your own hotels is that you have OPEX losses that go through the income statement on a new hotel while you bring it online. These you can't capitalize. And then the first year or two of a new hotel, it loses money because no one knows it's there. It takes a while to get really onto everyone's radar and integrated into all the tourist apps and all that stuff. And so if you're growing really fast like these guys were, all the new hotels are losing money. The core business is making money. If you look at it, in 2019, the core business is stripping out the new hotels. It's about 2 times cash flow at 15 pesos. And so it was really quite cheap. I mean, I think you're buying it here at 1-2 times cash flow of what 2019 was, and they didn't have to issue any equity. They've termed out their debt. I mean, I could see this at 30-40 pesos in a year because they're not building new hotels. So all the hotel vintage from 18 and 19 have now annualized and matured. They should recover with the historic hotels. I think it's a 5-bagger. Could be better. I don't know. But this is the sort of thing I would look for in the reopening trade. I wouldn't look for, Playa Hotels, which the EV is twice what it was before they started the COVID. It just makes no sense.
Right. So now, for everyone, it has to be kind of stressed here. This is, you actually have to go trade this on the Mexican exchange. There is no ADR. You are grabbing hold of your interactive brokers and figuring out the Mexican symbol and buying it in Mexico. Is that correct?
That is correct. The ticker symbol is HCITY, and from there you're on your own.
Okay, well, it's interesting as it's kind of
don't drink the water.
Yeah, that's right. It's kind of fascinating, and to be fair to the trio that are buying Playa Hotels, they're the first ones to tell you that they're not financial advisors and they're not looking at the fundamentals and they're just trying to surf what they call a social arbitrage. And listen, maybe it continues to go up and it's worked for them, but this just shows you how different people, different ways, and you're much more trying to find something with actual value, thinking that the market is actually efficient. How foolish of you. So the other thing,
I always get paid eventually. It always takes longer than I think, but I always get paid.
So let's talk about another kind of reopening. Well, I wouldn't even call it reopening. You've been talking about this thing with me. We've been chatting offline about it. It's kind of an interesting development, something you've seen in the market, and you're kind of wondering what's happening. Why don't you tell me about it?
So I'm sure this is one I'm also going to regret badly. This has literally been a widowmaker for value investors for about 30 years. But
but you got it figured out this time.
Yeah, I got this one. I caught the inflection. So the newspaper industry has just murdered everyone. I mean, this is one of those things where everyone looked at the cash flow, said these things are cheap, and then the cash flow just decayed every year because I don't even know anyone alive who's used a newspaper. I mean, these have comped negative for almost 30 years. It's stunning. But it was always this story that newspapers would eventually go digital. And it was always like this interesting thesis that value investors would tell you. And you'd look, and digital was like 1% of revenue because they had this screwed up problem where they charge you for the print, but you could go to the website and read the exact same articles for free. And then they hope to make it on the advertising. And it was just like a dumb business model because like one arm was competing with the other arm. And they basically drove themselves into insolvency, most of these newspaper companies. Over the last few years, though, New York Times was kind of the first to figure it out, that they started restricting certain content behind a paywall. And then eventually they put the whole newspaper behind the paywall. And they were able to grow the digital business very fast. And the New York Times was like a 20-bagger. I mean, if you look, the New York Times the share price didn't start doing anything until about 50% of the business went digital in terms of revenue. And then from there, you just had exponential share price appreciation. And the newspaper business has slowly shrunk away, and the digital business has grown very fast. both on the subscription side, but also on the advertising side. And so the New York Times, I don't know, it's probably fairly valued. It's actually probably overvalued, but whatever. That's not what I'm talking about. I'm looking at all the other newspapers globally, and there's a bunch of these. And every market basically has one or two of these companies. And they all looked at what the New York Times did. They said, we could do that. Let's not compete with ourselves anymore. We could do this thing. And so they licensed technology from other people, and they started doing it. And the damnedest thing happened. While the print continued to decline, the digital started growing. And from a very low base, the digital at some of these guys is growing 30 to 50% a year. And so when digital goes from 1% of revenue to 1.5% to 2%, no one really cares. But a lot of these guys are at the point now where the two lines are about to intersect. Maybe, this year, maybe next year, but they're at the point where the two lines intersect and digital becomes half the business. And at that point, I think you have the same effect as the New York Times, where people say, hey, wait a second, this is a digitally native business, or it's transitioning to a digitally native business. And, actually, print's a terrible business to be in. I mean, fortunes were made, like the Hearsts, like fortunes were made in publishing. But in the end, you have this giant warehouse with big printing presses that are always breaking. You have unionized labor. You have people delivering these papers in the morning. It's capital intensive and people intensive, and digital is very simple. It's a much better business, actually, in terms of profitability. So when you get to that 50% mark, most of your profits are actually on the digital side. And so there's a bunch of these guys, and 5 years ago, 10 years ago, the Marty Whitmans of the world said these two lines will cross, and he just didn't live to see the day. But these two lines are now 3 to 6 quarters away from crossing it in most of these companies. And if the New York Times is a good template, when they cross, you have a revaluation, because a lot of these things trade at 3 to 1 times cash flow. They all have terrible balance sheets and pension liabilities. And I'm not telling you any of these are pretty, but I will tell you that if you have a digitally native business that keeps growing double-digit rates, it'll revalue. And potentially quite dramatically. And many of these companies, they're off the COVID lows, but they're not up much. And I'm playing this with a basket. I don't want to name any names. I'm still buying a few. But I think a basket approach here is pretty good. And then a final point, and this is more hypothetical or wishful thinking, but this reminds me a lot of Facebook. When Facebook had all these eyeballs, they didn't know what to do with them. And eventually they figured out the ad tech, and they figured out how to have these creepy things on your cell phone that basically followed you around and sold you ads. These newspapers are getting phenomenal amounts of data in terms of what various readers are interested in. And right now they're just basically taking banner ads off a network and off an exchange, and they're selling you whatever dumb things the exchange sells them. But as they get the ad tech better, I think they're going to get much better advertising rates, which probably is a whole new revenue stream they haven't even touched. Okay, guys, laugh at me now. What am I wrong about?
I'm not going to laugh. And I know we've been chatting about it. And one of the things I find fascinating about you is, like, how do you come up with this? Like, what was the point where you said, hey, I'm going to go look at this? Like, because you were showing me some of the numbers in terms of the revenue growth that some of these places are experiencing, some of these companies are experiencing. And I'm just wondering, like, how did this come to your attention? And what was being your experience in terms of finding it and digging through kind of and figuring out this investment thesis?
I'd followed the New York Times, but I missed trading it. I missed the inflection there. I actually never thought it would really inflect, and it did. And I've been following a few of these other papers. In the end, I'm one of those guys, the curmudgeon, old school guys that still believe in cash flow. And you just do scans of every stock in the galaxy that trades at less than 5 times cash flow. And you get a printout and you go through them. You're like, nope, 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 nope. And so I do that once a quarter. And these things were always on the list, always. And eventually I said, let's go kick around. And it was a story told many times in my career, and then revenues declined 20% the next year.
Right.
But a lot of these now, because the digital piece is 25 to 40% and is growing very fast, the actual revenue stopped shrinking.
Yeah. I also think that there's been a change in attitude towards paying for newspapers and paying for content. I think that people realize that, and I also believe that people are paying for local stuff. Because it's one thing to, to go pay for your New York Times. Now, if you live in New York, that's fine. But if you're living, in Mid-America, you want to pay for your Mid-America, paper. Like I know here in Toronto, I found that with the COVID and all the crisis and stuff, I actually subscribed to the Toronto Star. And I would have never seen myself doing that a year or two ago. I subscribed to the Canadian National paper, but I looked at what the Toronto Star was doing, and I said, it's come down in price, and not only that, they're doing great work. And I put the two together, and I said, they got me as a customer. I still throw stuff out the windows at the politics of the paper. But anyway, so, I do think that there's a little bit of a trend there. Do you agree, or do you push back on that? Like,
I don't actually know. I mean, I've surveyed all my friends, and not one of them is paying for local paper. I don't know what's driving this, quite honestly. If I knew what was driving this would be a much larger position for me. Because when you see one of these trends and you're like, okay, this thing's growing really fast, who the hell is the customer and why? And I literally don't know.
Well,
you could be right. Like regional papers could be.
I'm going to throw this out there for people. Tweet us. Let us know what you think is driving it, because there's no doubt the company's looking backwards. He's looking at the numbers and saying, "Hey, there's growth here. I want to buy this." But we still haven't yet figured out why it's growing. We don't really understand yet, right? I'm not putting words in your mouth, am I?
No. I mean, I literally don't know why this is working. I just know that it's working. The hypothesis we have is, people are switching from national back to local because they're just disgusted by national news, which is very politicized, and they're sick of hearing about Trump or whatever it is. It could be that these guys figured out how to deliver the product in a better way. The product used to be on a web browser, and now it's on an app. So it's much more seamless and easier to use, and you could jump around between the stories that you want. It could be that the print version is $30 to $50 a month, and the digital version's like $8. So people are just like, whatever. If I don't read it this week, I don't really care. It's $8.
Well, I do think that there is an element of that. The stimmy checks. That was one of my first gut reactions. Was
that the first thing you did with your stimmy check?
Yeah,
was
I
buy
bought
a
the
digital
Toronto Star.
You are one weird man.
Yeah, I am. Listen, we can't let you go without talking about Archegos, or I don't even know how to say it. I kind of like how Carson says it. Archegos. I kind of like Carson's line. What do you think's happening there, and do you have any insights to share with us?
Wow. How did some family office I've never heard of have like $200 billion of equity? And if you're going to lever it up, why would you buy Viacom? Like, really?
I was asking the same question, to be honest. Like why Viacom? I mean, but they ran these things pretty hardcore, did they not? Like, unbelievable run before it blew up.
Yeah, but why not go do like Tesla or something? Like, I mean,
maybe they did. Maybe different companies did it. Okay, here's a question for you. Out of the whole pieces, which one do you like best? I got to think it's Discovery.
Yeah, I think the Discovery Ks are somewhat cheap, and I wrote some of the puts.
Okay.
I don't mind owning it, but I'm not like dying to own it. But I don't mind collecting the vol, and I wrote them at like 120 vol, which is always, thanks Credit Suisse, you've made me some money. You're in this incoherent selling program pushed a boring old line media company to 120 vol.
Yeah.
Good job.
Well, my favorite part of this whole story is that as these brokers, the prime broker has pitched all their product, like sold it out in the market. It's the Morgan Stanley that quietly did it the first night. We thought that Goldman was the first out the door, but I think we now know that it might have been Morgan Stanley, and they pitch a unique opportunity to their most favored hedge fund clients to buy a piece of these blocks right before the onslaught.
Oh my God.
The whole thing is absolutely crazy. I mean, I would think there's probably other funds like this out there lurking. There were a lot of companies that just went up, bizarrely for a year with very low volatility. Like there's just perpetual bid underneath it, just, hoovering it up and pushing it higher. I have to think there's other very large levered funds that did crazy stuff like this. But one last thing. I'm going to call bullshit on this story that some guy leaves Tiger. I mean, he wasn't even very senior in Tiger. And suddenly 5 years later, he has $20 billion. Like, I just don't understand how that's possible. I have to think something else was happening here. You know, the Viacom, the Discovery, I have to think he had some ulterior motive, whether it was some sort of M&A thing or some sort of structured deal he was trying to accomplish. He was trying to do something and it didn't work. But he was trying to basically consolidate or accumulate these massive blocks to force something to happen. I have to think that was the plan.
Yeah.
Okay, well, that's interesting.
So, Kuppy, I've got some news, buddy. I'm going to be down in Miami again in June. So I'm going down to Miami to speak at George Gammon's show down there. But I'm thinking me in Miami, you in Miami. Like, I'm just going to put it out there. Like, what if we organize a little market huddle piss up with our listeners down there?
Let's do it.
Yeah? All right. Well, listen, first of all, any of our listeners that would be interested, poke us either on Twitter or let us know so we gauge the interest level. But maybe next time you're on the show next month, we can kind of throw some details out there and see what we can put together. But yeah, looking forward to it. Last time, it was a very expensive experience for me last time I saw you. And I guess if it's a piss up, then I have a lot of beers. Kev, are you going to allow me to allocate some of our bet beers to some to buy a couple pitchers down there?
You can go buy a couple pitchers there. I can't be the one to stop you guys. Plus, it's American beer. You're going to have to buy more than a couple of beer because it's kind of watery.
You went there. You went there. Unbelievable.
I'm just
Why don't you define what a piss up is for all of us Yankees that have never heard the term?
Yeah, Kev, please explain.
Well, a piss up, like, honestly, you guys don't say that word? Is it British?
No, that's uniquely
British.
Canadian.
I think it's British, actually. Let's just Google this because I think it's British. It's kind of like it's a big night of drinking is how I would describe it, like a piss up. Here we go, British. It is vulgar slang and it's British. It says spoil or ruin something. That's not how we use it. So maybe it is Canadian. Oh, no. There it is, drinking alcohol. Anyways, it's just kind of like, when you're going out with the boys and you're just going out and you're going hard, it's a piss up. Like you're just going to go and it's going to be a night
It's now a market huddle term.
That's right. Everyone's all confused about Goocher. And everyone has like, where's this from? What is this Canadians? It's actually from Stand By Me. And people don't realize it wasn't the fat kid that ended up stealing John Stamos' wife. It was the other guy, which was, by the way,
important facts. These are important market huddle facts.
By the way, it was the best line in a roast that I've ever seen. And it was John Stamos was getting roasted, and it was something to the effect they got up there and they said, I really love John Stamos and stuff like that, even though he lost his wife to the fat kid from Stand By Me.
There you go.
On that note, listen, you guys have fun without me. Enjoy yourselves. I look forward to hearing all about the piss up. Kuppy, enjoy yourself in Puerto Rico. I was going to say Puerto Vallarta. I thought you were going to Mexico. All the Puertas kind of blend into one for me. Can we tell everyone that you're making a full-time move, aren't you?
Yeah, I'm going to Puerto Rico.
You're gonna be have a new address. It's gonna be awesome. Like, is that a different time zone?
No, but they don't believe in daylight savings, so it kind of switches back and forth.
Keeps you hopping.
Keeps you hopping, yes. But no, I'm moving to Puerto Rico. I'm keeping my place here. I'm going to come back to Miami quite a lot. But no, I'm moving to Puerto Rico.
Great. Awesome. It's just because all those New Yorkers came down to Florida. You're like, I got to get out of here.
They ruined it.
Yeah.
All right.
Okay. Great. Thanks for being with us. Take care,
it
buddy.
was awesome. Take care, buddy.
Talk soon.
Okay, Patrick, it's time for Talking Charts. You got the hat on?
Yeah. All right, let's do it. Let's dive in here and have a look at what's going on here. But so it's been several weeks because we had that holiday special last week. So I'm not going to go back and re-review the one from all the stuff from 2 weeks ago. So let's just jump straight into what we're watching next week, right? And the first thing, before we even get to charts, we have to talk about all of the economic data and bond supply information that's coming out next week. What are you watching?
Well, there's a lot there. we get a bunch of Fed speakers again. We get Powell. And then we get a big ton of treasury paper, which is the supply, 3s and 10s Monday, then 30s on Wednesday. From an economic point of view, there's a lot happening. Keep your eyes peeled.
All right, Kev, let's move on to number 2. And I wanted to talk a little bit about Boeing. They announced today some electrical issues in those Boeing 737 Maxes. And do you remember the days when those kind of announcements used to actually hurt the stock?
Yeah. There was a while there where we were watching every single one, and it was, making the Dow zip around because it was such a big component part of the Dow. And I know you love watching that index.
Oh, well, I do watch it. But anyway, I wouldn't use the word love, but it is something I watch. So what I thought was really interesting is that we've seen this really over the 2021 year. You can go back to some of the drops that happened in the start of the year in January, and including this one here in April. But it seems like all of the sellers that were going to ever sell on all of this negative news toward these issues they had already sold in 2020. And it seems like the stock doesn't go down on negative news anymore. And when I see that actually I construe as somewhat bullish, because if bad news can't take a stock down easily, then that means it's being well defended and it's got a pretty strong base. And so I just thought it was really interesting that the stock held up. This trend has been pretty distinctly higher, and it'll be really interesting to see if next week leads to an actual bullish breakout in Boeing. Anyway, that's definitely what I'm watching.
Okay, what do you got for number 1?
The commodity index, bud. This is okay. So we keep talking individual commodities all the time, but I really wanted to just look at them broadly here for a moment using the Bloomberg Commodity Index. And this is the futures on it, the AW series. When we look back to what happened from November into early February, was an extraordinary reflationary bull advance in the entire commodity complex, right across the board. And we've now gone through a 1-month correction. And what's really interesting to me is this, is that in a bull market, it is quite customary that advances in the market are always checked with retracements or pullbacks, a mean reversion of some sort, to just normalize the price. And we are now 1 month into a correction, and often many of these corrections can last in that kind of 3 to 6 to 8 week window. And what I'm wondering now is, was that enough of a correction? Is this all that we're going to see in this commodity index, and suddenly it blasts off higher? And we have to step back and ask, what are the macro drivers that would have to be in place for another such impulse to get underway? But it's now been a 1 month correction. You can connect trend lines along all of these previous highs, and it'll be really interesting to see whether this was enough selling for the commodity index to make another punch higher. Obviously, with the importance of crude oil in the weighting into these types of indices, it's going to be a lot about whether or not crude oil can hold that 50-day. We'll get to that chart in a bit, but this is what I think is one of the more interesting things to watch, and we should definitely watch into next week. What's your feeling about commodities here?
I think it's a fascinating thing that you brought up, because it really was what was leading the market, and we, as you mentioned, we've gone sideways for a month and a half now. And I would have actually, if you would have told me that we would have a correction and it wouldn't correct more than a couple percent, I would have said you're wrong. But to me, it kind of feels more like it was just a pause in a larger up move. That's what it feels like based upon the action. I don't know if I'm reading the charts correctly.
But are you also, okay, like, let's not look at commodities as an aggregate then. But I mean, I think that when you look at when the top of the commodity index occurred, it corresponded not too far away from the bottoming formation of the dollar, and basically the wind was taken out of the sails of that whole reflation trade. The bigger question I have for you is, do you think that a resumption of potentially dollar weakness could be the catalyst that drives commodities higher? Or do you think they even need a currency tailwind?
I think a currency tailwind helps, but I don't think it's needed. Everyone always thinks that this can only happen. Commodities can only go up if the U.S. dollar is going down. Be careful with that because we're in uncharted territories. The amount of stimulus that is out there is just shocking. And I think that you have to be careful about assuming that relationships like that have to continue to, work, and they might not. I could see a situation where the dollar goes up and, maybe it doesn't rip higher, but it grinds higher and commodities grind higher as well. It can happen. A good trader
Don't
never
turn
says,
my universe upside down.
Yeah, well,
Kev.
a good trader never says never. So that's what I would say. So be careful about assuming all those things have to be.
No, for sure. Well, you know what? I was going to go into equities, but let's actually stick with commodities then for a second because, why? How can we not just then quickly just touch on crude oil here? Because similarly, after putting in an early March high in crude, we've been going through more or less an entire month of just backfilling consolidation, where we had a solid $10 pullback in crude oil, right? We dropped about 16% off of the highs and consolidating down. And I think in order for the broader commodity index to get going, because there's individual commodities that can that can start running, but I think that we'd have to see crude oil break out here in order to really see that Bloomberg Commodity Index get underway. So you think that crude oil can do that, or you think that is this a part of your narrative?
Well, I'm sticking with the fact that I think that by the end of the year we'll see $100 crude.
Okay.
And so
I'm not bearish crude, so I would consider that a gift. Thank you very much if you're right. That is interesting. To me, it really is about identifying the buy and dip, right? And there are a surprisingly large amount of traders. When I was building my initial kind of analog of how I thought crude oil could trade, I continue to see the vulnerabilities into the fib zones that lie in the, let's call it the 50-55 pocket, where we could see another 10% drop in crude oil into what would be a buy zone. But the amount of people looking to buy the dip in that same zone, it bothers me. When it's almost consensus as to where the buy on dip zone is, sometimes you're not given that opportunity. Are you hearing that same thing, or is it just my little circle of people that I
don't
follow?
know. I find that when I listen to crude people, they're always bearish.
Really?
Yeah, I just like that other show you cheat on me with. Do you ever get a bull on there?
Berman was bullish at the when we had him on last. Obviously, that he caught it right before the real breakout.
Yeah.
But he's fading it already. So
yeah, and not only that, he's pissing off the EFT. Okay, what do you got next?
Okay, no, it's okay. Let's keep moving. So copper. That's not cash. So let me just put up copper here. Where do I have it? Where did my copper chart go? Anyway,
I'm going to fill it while you're talking about. Oh,
there
it
it is. Okay, I got the copper chart. So there was that breakout we talked about in our midweek update, right? And to me, obviously, I think the $4 level becomes really important because it was the $4 round number that was just gapped through. With some real velocity on the breakout. And so far, it's just been consolidating. But I think that the bulls really would need to dig in copper here north of 4 and hold the line for this to really follow through on the upside. That's going to be really interesting to see whether they can do that. But what I wanted to really highlight was, what the hell is going on with lumber? Have you been watching this?
Everyone that has to build in the midst of building a house is complaining about it. It's absolutely insane. You see it on Twitter that people are talking about there'll be a contractor with a load of lumber and there's jokes that they should need a kind of a police escort because the lumber's worth so much. It's insane. Lumber, we were just talking about this. So lumber's $1,100. Last time we talked about it, we thought we were top ticking it, but obviously that was not the
at
case.
$920. Yeah.
Yeah, It probably was a short-term top tick. Now that I look at it, 920, there was a short-term top tick there, so that probably was.
That was a short-term overhead resistance as these little moves finish. But with this breakout, I mean, I was talking about it with big picture trading members, and we were measuring to this very level, and maybe we're Gucciing it by now, like really highlighting it up here. But this is in my mind where we're reaching that there isn't as much asymmetry in the trade, where it's going to bump its head, and the risk of getting caught in some backfilling correction is probably now greater than the potential further upside. But who knows? With this
tough,
kind of momentum,
like it's with all these commodities like corn, all these things, it's tough to buy. By the way,
did
I
you
just
see
want
corn?
Yeah. Well, go back to the lumber though, just quickly. I just want to prove something to you. So it had the one move up to 920, then it had a correction, then it went back up to 920 again, then it corrected again. And I'm sure at that point at 840, like there, do you see the second time it went to 840? A lot of people were probably talking about
double
how
top.
that was a double top. But then it went back up to 920, and there was no way it was going to be a triple top, because we all know they're like unicorns. They're not real.
So I talk about this in my technical master's program, is how the ascending triangle formation gets mixed up with the double top. What happens is that people mix up overhead resistance with a topping formation. And so what often happens is, like this, if you think about it, it's like bumping its head, but it's making higher highs. It's being well accumulated, and then all you need is one more kick, and it actually becomes the midpoint, like that old saying that flags fly at half mast. As soon as you have the breakout, that becomes the midpoint of the next extended move. And what happens is all the junior technicians just see a retest of a previous high, and they're all parading like it's a double top, and it's just way too early to be making such a call, because there's no distributive price action. Just because it's bumping its head on resistance doesn't mean that it's being actively distributed. All right? And there's a lot of junior technicians make that mistake.
Listen to this wisdom we're getting, folks. Listen to
stop it. Okay,
that's why you have to become a big picture trading member, so you can get this wisdom on a regular basis.
There you go. So, but look at the acceleration of the slope. And we've talked about this so many times before. And whenever you have this, usually, whether it's the thing we don't talk about on the show anymore, or any of the asset,
the asset that shall not be named,
the asset that shall not be named, there are these accelerated moments, and often it's not that there has to be a massive change in trend, but it is from a time frame perspective a point of massive exhaustion that will, on the upside, that will mean revert. And it would not shock me if at some point in the next month, lumber's retesting 1,000. Doesn't have to be a new downtrend. It doesn't have to be a major top and a new bear market coming. But usually when something blows off this hard to the upside, it'll mean revert. And this is not a tactical time in my mind to be buying new lumber positions without a pullback anyway.
I completely agree. I wouldn't be surprised if lumber this summer is back in the 8 handle.
What? Now that's bearish. I wasn't going to say that. Look at you.
It's gotten way ahead of itself. This is dumb. This is dumb. And so.
It's all the crazy Canadians building real estate, right?
Exactly. It's all the Torontonians building real estate.
Unbelievable. All right. So is there another commodity you want to touch on? Let's go equity.
Let's go. Let's talk about the equity.
So the S&P 500 ripping to new highs. But what I wanted to talk about is not the S&P doing this, but the NASDAQ is double topping. Well, there I say, look at me.
There, you're doing the same mistake.
It's approaching its previous highs. Let me correct myself. It's approaching its previous highs where overhead resistance can be a challenge. And so we're going to find out whether the NASDAQ bumps its head along that February high. But what I find really interesting is that the Russell just can't get off the mat.
Okay, so do you know what I find really interesting? The fact that every time I talk to you about this stock market lately, I feel like I'm talking to General Akbar. Because all I hear is a bull trap.
It's a trap.
It's a bull trap. It's a bull trap.
I don't know. There isn't a meme for that.
Oh, wait, I screwed up. It's like, you know what? All the Star Wars fans are going to be like, God, he even screwed that up. Admiral Akbar. I apologize. I got that wrong. He's not a general. He's an admiral.
You get it right, dude.
Yeah, I stepped all over my own joke. Anyways. Serious question. Is this a bull trap, Patrick?
I would say that yes.
Of course it is.
Yes. It is. It is. Okay, we'll leave it at that. It is.
Patrick's calling back the X-Wing fighters.
No. Stop for a second. Stop for a second. I want to emphasize that I'm not sold on an idea that somehow after this COVID cycle that we're going to have some sort of imminent new bear market or something, that some major stock market top is coming in and, another 30 to 50% wipeout in the stock market is imminent. Don't put that shit into my mouth, right? But I honestly believe that the current equity cycle has impulsed higher. Then this is very 8th, 9th inning for a correction. And I think that one of these 10 plus % market corrections that last several months is very likely going into the summer. And it probably will be a buy on dip. And it's probably not something that everyone should be going to cash in their entire portfolio. But I honestly think that this equity move is very mature and a correction is likely. And so this is why I would say it's a trap.
You know why, Patrick? That's very, very elegant and or eloquent. And you've really made the case very well. But the thing is, you're wrong. And I'll tell you why you're wrong.
All right, tell me. Is it a TGA account or something?
No, it's because I agree with you completely.
Oh, yeah.
So
don't Gucci it.
I'm sorry. I agree with you completely. I do think it's a bull trap. I think we're sucking in the last of the longs. So there's no way this is going to work. There's no way we're both going to be right.
Both going to be right. No, that's not going to happen. Yeah. So our listeners,
so there we go.
Warned.
Everyone be aware. This thing's going to scream way higher because Patrick and I both think that we're getting towards
But you know what, though? What's interesting is that it could be one of those bipolar markets where certain sectors continue to rip. Where I feel quite comfortable in saying that it's a bull trap is in those things that worked so well last year. Dare I say the Tesla? I don't want to. You don't have to comment, or I understand the sensitivity of certain symbols, but I do not think that even if we go ripping higher, that a Tesla is going to new highs. And I'm like watching that 750-800 window. Like if one more rip higher, I think that could be that's where I think the bull traps really are. That maybe even outright ARK investment in the ETF or any of these other things that they're just not going to new highs.
Patrick, you're a non-believer. You just don't understand.
Yeah, you know what? I'm sure the hate mail is about to come roaring in. Yeah. But
so I stepped all over you in terms of the Russell, the small caps. Why don't you just tell us what you were going to say?
No, all I'm just saying is that you know what? There's rotation because the small caps were leadership. Through November through February, March, the small caps were the place to be. The financials were the place to be. Do you think that it could be the fact that just bond yields have stopped rising? Like, I'm not saying that they have to. There's some sort of bond bull impulse that has to come screaming higher, but we've really generally seen bonds kind of hit a short-term tradable low. And they're stabilized. Do you think that that kind of rising yields was the kind of tailwind that drove financials and cyclicals and all of these other areas so well? And the fact that bonds have put in some short-term lows, that could be why we're seeing this kind of underperformance. And there's almost like here, I have here that chart of the Russell over the NASDAQ, and you can literally see March 12th was where the date that the Russell over NASDAQ ratio reversed, and that was like within days of the bond yield top.
Yeah, so I don't know if one causes the other, but I completely agree that they're moving together. Yeah. And I don't know if it's just a function of the reopening trade getting, having too many people in it. Bond market is priced in, like, let's just talk about the short end. The bond market is priced in a lot of, raising. Like it used to be that the Fed's trying to tell us.
When you want to look at the fives, or
really to figure out what the Fed policy is, you actually should use euro dollars aren't perfect, but they're probably the closest thing. But if you look at it in terms of, because it's so far out, usually you can use the Fed Fund futures, but because the first hike is so far out, it's not quite as good. But if you look, let's just assume that there's no credit risk and that euro dollars are a good proxy. It used to be kind of that the first hike was priced in 2023. The Fed was telling us it was going to be the end of 2023. Over the last, little while, that's moved up from 2023 all the way to the point where at the end of 2022, they now have almost 1.5 hikes priced in.
Yeah.
And this was 0 just a little bit a while ago. And in terms of the end of 2023, and don't forget, the Fed's telling us that they're not going to be raised by the end of 2023, or that's when they're going to start. They've got 4 hikes priced in. So there just hits a point, and back to, we had Guy Leboeuf from, Janney on, and he said, there hits a point where the curve gets steep enough and you just end up getting people attracted for the carry. And I think we're there. I think that although I am the biggest bond bear out there over the long run, I think that the curve is steep enough that you can play it at the short end, and that's what's happening.
And maybe that's the rotation, and maybe that's why we, in the last 2-3 weeks, the kind of NASDAQ and tech names have generally been the place where a lot of the money flow has been going, right?
Yeah, and so I just think it just got ahead of itself, and I still think that rotation's like longer term is going to work, meaning the rotation into value and out of the kind of large cap growth stocks. But I think that it was due for a pause, and that's what we saw for the past couple of weeks. And the real question is this, pause go on for another month or two, or is it end up that we rip back into value, in the next kind of probably next week? I don't know.
Boy, it's almost like we have to come back each week and analyze this week after week, right?
It is, but good thing we have you and your little magician stuff to help us out with all this.
There you go. All right, bud. That's enough for today.
Okay.
Let's go on.
Okay, it's time for This Week in Trading History. What do you have planned?
Well, I want to talk Microsoft, and where there's actually 2 dual dates. It was on this week in history, in April 4th of both 1975, which was the founding of Microsoft, and the monopoly ruling in 2000. So let's talk about both of these events that occurred 25 years apart from each other. And so I want to start off just talking about a little bit of the history. Before, during the 1960s, to get access to a computer was essentially, they were in universities or major corporations. You had timeshare. You just couldn't get access. The idea of a personal computer just never existed, right? And so then comes in 1969 comes around Henry Edward Roberts at MITS, which was the micro instrumentation and telemetry systems company that came out with their new Altair 8800 personal computer. Have you heard of this thing?
Yes, the Altair. I do.
Yeah.
I do.
And so this machine, it's crazy to think what the first personal computer was, but no keyboard, no monitor. It was just little lights and switches, and to program certain numbers, you had to hit 8 switches. It's some just crazy, but it was the first origins of personal computers, and this really caught obviously Bill Gates and Alan in just wanting to take this next level. So Gates calls up Henry at MITS and offers him and Alan's services. Now, this is the best part. He claims to Henry that they are very close to being done writing a programming language for this Altair 8800, when in fact they didn't even start one. They literally faked it. And they call him up and said that they're close to having it. And so they set up a meeting 8 weeks later, basically claiming that they had this version of this new basic programming language for this thing. And so Henry agreed to see them. And so they demonstrated 8 weeks later. So they basically, Bill Gates and Alan basically demonstrated that, and within 8 weeks, that they had this product for this system. and they got a contract, which was basically to produce this Altair Basic programming language, and ultimately inspired them to start their own software company. And so it was on this day in history, on April 4th of 1975, where Microsoft was registered as a corporation in the beginning of the Microsoft story. And do you have a comment?
No, I got lots of comments, but I want to wait till the end.
All right, no problem. So then I just wanted to fast forward 25 years later. It was on April 4th in 2000, in a stunning setback for Bill Gates, which didn't in the end end up being a big setback at all. But back then, anyway, a judge ruled that in a Microsoft antitrust trial ruling that the software giant was a monopoly and wielded way too much power, stifling competition. So using harsh language, the judge at the time delivered his much anticipated finding of his facts and his take on the contradictory evidence and insider emails that had surfaced since the government sued Microsoft for these antitrust violations 2 years earlier. But in the end, the judge imposed all sorts of sanctions on the company. But fast forward about 18 months later, when the DOJ reached an agreement with Microsoft to settle the case, proposed that they require that they allow the application programming interfaces of third-party companies to be able to come in, and they appointed all this panel of people that would essentially overlook this. But in the end, they did not require Microsoft to change any of their code, and didn't prevent Microsoft from trying or tying their software with the Windows into the future. And, well, we know where Microsoft is today, right? And so even with a ruling of it as a monopoly, didn't change much, did it?
Nope. But, Patrick, I got a couple questions. Am I allowed to talk now?
Please.
Okay. So first of all, I'm very impressed that you went and dug that picture up about Bill Gates on the desk. So for
He
those
was a handsome lad.
For
right?
those who don't know, just type into your Google search box Bill Gates on desk. Okay? And he's like, I don't know if he thinks he's posing for Playgirl or what's going on here. But they put some drinks in him, and then they said, listen, get up on the desk and act all sultry around your thing. Whoever convinced him to do this, and he actually said, yeah, that's a great idea. Like, that photographer, hats off to you that you convinced one of the richest people in the world to take these terrible pictures is awesome. Patrick, there was better ones you should have chosen is all I can say. You chose the one that was a little
more tasteful.
Yeah, so that's the next thing. Then the next thing is, Patrick, I didn't realize you got your COVID shot yet.
No, I didn't.
Well, then why are you doing Bill Gates? I figured that this is what's going on. You got your COVID shot, and it actually the virus, and Bill Gates is giving you instructions to do Microsoft This Week in Trading Histories. That's not what happened?
No, it's not, unfortunately. But I'm sure that is an imminent side effect.
I know he must be busy though, right? Because let's face it, lots of people have been getting their COVID shots, and he can control them all now. So the reality is that he must be busy.
But he's going to dim the sun too, isn't he? Or
That's what Lito was telling us beforehand, that he's got a plan to dim. Lito, hop on and tell us what's happening with Bill Gates and the sun.
I don't know all the details, but I heard that there will be some sort of, like a chemical cloud that they're going to, shoot into the air or near the ozone to prevent the sun from, or dimming the sun, let's say, so that we can try to, quote unquote, cool down the planet just a little bit because of the global warming.
Because nothing will go wrong if we try to do something like that. There's no way there'll be unintended consequences. It's almost as good as Elon Musk's partner saying that Elon Musk could create basically the latest Jurassic Park. Did you see this? Yeah. all I can say is, like, what drugs are these guys on? Like, they just
No,
get
they're visionaries. They're
I'm
visionaries.
sorry.
No,
I'm sorry. You're absolutely right.
Right? Because there's a fine line between being a visionary and a lunatic, right? Like
for sure. And you know what? Thank God we have Elon Musk. That's, I see that he put out this new video of him of his company that with a monkey that's playing video games. Right? Have you seen this with his brain?
No.
Right? And well, this is the latest thing. And listen, completely awesome technology. This is terrific. But I'm so impressed that Elon Musk, in between landing the spaceships, making the car company, has had chance to program all this up.
Yeah,
like,
that's
just
impressive.
a little bit,
It
like
is pretty
that's the
impressive.
weekends, right? Like, and then he gets,
He was the richest man for a while. I don't think I think he lost.
and
the
then he
title
gets
in the
high,
fallback.
and he's gonna make Jurassic Park. Like, that's literally, they like get hey man, it'll be awesome. Let's make Jurassic Park, yeah. And listen, they'll probably do it, and nothing will go wrong. So him and Bill should get together.
Nothing will ever go wrong.
Yeah. Anyways, that's my.
Anyway, that is history and the future all in one session. All right, let's go on. Kev,
Time for skin in the game, and I lost another one.
Yeah, you did. But
Yeah.
but you know what? It's funny because so let's go through. We did the bet on Viacom, and you tried to lure me in.
I tried to lure you in, and I
and
misjudged it because I misjudged that you would. I kind of thought the 3980, because anyways, Viacom had fallen, and I said that it would touch that new low, and I thought it was a one touch, so you'd be interested in it, and you didn't fall
Like a
for
double
it,
bottom, yeah,
and
like-
you did it.
It was a 4-day shortened week, and it was.
I
Pretty
know. You know what I
oversold.
realized? You picked me off a couple of times. I'm not that aware of the calendar as you are. You're much better on that, and you definitely put that into your equation much better than me. It's something that I've learned.
Okay, so
well done.
Kev. Yes.
Yep.
So why don't you quickly explain the rules, and then we'll make this bet.
Okay, so Skin in the Game is our weekly opportunity for us to demonstrate that we are degenerate gamblers at heart. Every week, one of us presents a wager, and the other guy chooses which side of the bet he wants. Each wager needs to settle by the next episode, and the currency for the wager is everyone knows this. It's what is it? Beer and the meat of dead animals.
Flesh of dead animals.
The flesh of dead animals. That's right. The winner of the bet is obligated to create a new bet for the following week, which is you, and all wagers settle in full, and there will be no netting of positions. They will all get settled up at the Market Huddle piss up. Although
That's right.
you are going ahead and cashing a few. I love it how you put me on the spot with Kuppy. You won't mind if I spend a little of our beers there? Of course.
Yeah, well, I think it's
what am I
only
going to do?
fair.
Look like an idiot and go, no,
I know, but this is the way that I can. It allows us to do a fair distribution, because if we only did it at a Toronto piss up, then it's only the people geographically willing to come to Toronto that will get the benefit of all of this beer.
Okay.
But we can sprinkle
I love
a little
it how
bit.
you're trying to now make it seem
No, we'll sprinkle some down to Miami. We'll
Equitable, even though you
sprinkle some
picked
beer.
me off. But it was well done, very well executed, Patrick. I like it. You basically found a way to go drinking with Kuppy and get it on my bill. Okay.
and our listeners.
That's right.
And our listeners, whoever decides to show up. So here we go. Here's the bet. I get to make it, right?
Yes.
Yes, because you know what? Since we decided that we can't talk about another OPEX rollover,
That's right.
Going into
Patrick
next
wants to
week's
put
monthly.
OPEX rollover in what to watch
Once a
next.
month, every
Yeah.
month. It's just like literally we just calendar it in,
Yeah.
and we're like, no, we're not going to talk about it. So I figure we're going to take the bet there. all
Okay,
right?
fair enough.
So we're talking S&P 500 into the monthly option expiration.
Okay.
And the big call wall. Where there's a redonkulous amount of open interest is the 4,100 strike on the
Okay.
S&P 500. Let's just make it simple. Over, under.
Oh, that's a good one. So is it expiring or is it the close on Friday?
The close on Friday. When we're recording this show.
Okay, the close on Friday. So the close Friday,
where
and
this
it's
continue-
cash.
we're watching- and
Are we
we're
doing
watching this
futures or are we doing cash? 'Cause-
No, we're doing the S&P futures.
Okay.
This E-mini futures continuous
'Cause
chart. The
technically-
very one. I understand.
okay.
What you're technically, but this is the actual chart we're betting on.
Okay.
We're betting on the continuous futures contract.
Well, June. We're betting on June.
We're betting on June's.
Okay, and June, June is right now 41.14.
Yeah, the ESM 2021 contract.
And we're gonna
4,100 pivot above or below.
Oh, that's a good one. I'm going below. I'm taking below, buddy.
Okay. All
I'm
right.
taking
so
below.
Where do you want to set it?
Well, listen, I don't think you're going to go high because I think you wanted me to go up. But I'll go all the way if you want. You name your thing. I'm willing to go all the way to steak dinner.
No, I can't do steak dinner on that. I'm too bearish inside.
I know. I'm talking to Admiral Akbar. Of course I know that.
I'll do a burger. Let's do a burger.
Okay.
We have to tally up because I think we owe each other like 4 burgers.
I know. We got to listen. We're not allowed out. We'll talk about that in the after hours. That we're all locked down.
So you up for a burger bet?
Yeah, that's fine. I told you it's dealer's choice. We're
doing some flesh.
Yeah, Yeah, the meat of the flesh of animals.
I want a turkey burger though. No,
yeah, I don't think that's
all right. All right, here we go. All right, so that's that. So let's move on because it's time for No Stupid Questions, and this is where we get to invite Lena on the show. Lena, how you doing?
Good. I finished the beer, so I'm feeling pretty good.
I know. It goes by quick.
I've been talking so much that actually, I'm almost done.
Yeah.
All right. So, Lena, what do you got for us?
So, first question here. Hey, gang, I keep reading that stops or stop losses are important. At some point, you have to pull the plug, whether A, you blow through a support line, B, your trade thesis is proven wrong, or C, maybe the trade is taking too long to develop. But when do you pull the plug on long-dated options? If you buy 10 January 23 calls on your favorite pot stock and people totally stop smoking weed and the stock tanks, would you sell the call at
Unlikely.
the same underlying stock price?
This ain't going to happen. Like, have you seen how many people smoke weed in Toronto? There's more pot shops
than convenience stores.
Than Starbucks. Literally, I have 3 that I can walk to. Just out on Yonge.
The local barber shop down the street from me that I've been going for 30 years is shut down, and immediately a pop stock story pops up right there.
It's unbelievable. Anyways, go on, Lena. Sorry.
This listener says, I love the leaps, but how much patience should you have with the optionality and leverage that long-dated options bring? Cheers. P.S. Please stop drinking coffee beer. I can taste it mentally when you drink it. P.P.S. Buy the asset that we should not.
That shall
you
not
can
be
say
named.
it. I can't say it. It's kind of like that's like kind of makes me laugh. It's kind of like send nudes.
All right. Do you want me to take a stab?
Oh, this is all yours, buddy. I'm not even going
all right.
there.
So now the 2 things that first of all, what our listener here is talking about, A, is some technical analysis because we're talking support lines. But number 2, they have a trade thesis, which could or could not be proven wrong, or it's taking too long to develop. So I think you just break it down into there. When you're using leaps, in my mind, it's all about the idea of that you have a trade thesis because the convexity and the very nature of the gamma of the way that you're long an option, the more you're wrong, the slower the rate of loss occurs on your option. And so if you're wrong, the option is already defining the downside risk. So I think the kind of trigger for me for getting out of a leap is if you're just wrong about your thesis. If you believe something was happening and that thesis is just not materializing, that is for sure a reason to get out of a leap. But the idea, like for most people, when they're Delta 1 stock positions, they're stop lossing because things can spiral crazy out of control on a stock that just starts dropping. With an option, you have a very predefined risk that you can have there, and therefore you have a lot more flexibility to hold. But I mean, it's very unique to each trader because each trader sizes their trade based upon certain exit strategy, based upon the risk that they perceive that they're undertaking. And so you have to reflect on what, like if I went out and took a position on leaps and I did it far beyond my risk tolerance in terms of what I would be willing to accept if they all got zeroed, well, then you have to use some form of an exit strategy to recover the capital if the trade is wrong. But if you size the trade with the idea that the leap zeroing is your risk, then you don't have to be so eager to pull out on a technical signal. Does that make sense, Kev?
It makes perfect sense. Don't be eager to pull out is what Patrick's advice is. Okay, what do we got?
That doesn't sound right when you say that.
Lena, what do we got for now? Oh, God, this is a long one. Okay, go, Lena.
Hi, everyone. Love the show. The Market Huddle is definitely my number one investing podcast. It used to be number 2 behind that other show, but I like that you guys actually let Patrick speak.
Whoa, Patrick started laughing. Make sure you read that again, Lena.
This listener likes the fact that we actually let Patrick speak. I'm new to investing, having only just opened my first brokerage account after COVID hit. Actually, my first trade was in oil tankers. Thanks for that, Patrick. Maybe your other co-host was right in not letting you talk too much.
Wait. Is he mixing me up with Kuppy?
No. I think he's saying that. Well,
yeah, no. Actually, I did for a while do some shipping stocks. Okay, go on. Sorry.
My question concerns stock dilutions. There appears to be a knee-jerk reaction anytime a company decides to issue shares and dilute their stock. Everyone hates it. Social media accounts start yelling, "Stop diluting me." People seem to get quite upset by it all. But isn't stock issuance the whole point of the stock market? I've thought about this a little bit and wonder what you think. Am I right in thinking that if a company issues stock when their expected return on capital is higher than the stock's current earnings yield, then the dilution is actually beneficial to current shareholders? And vice versa, when a company's stock has a higher earnings yield than the expected return on capital, then issuing stock is bad for existing shareholders. Is this roughly correct, or am I missing something important? P.S. Has Kevin ever considered doing voiceover work for animated movies? He sounds a lot like that snowman from the movie Frozen.
Wow. So gloves off, the cheap shots come flying. Everyone's in. I love it.
Olaf,
I love it.
Olaf, right? That's the guy's name. And listen, are you sure that's not me? Things were tough trading for a little while, going and doing a little Olaf.
A little side gig to get.
Okay, so
you take this.
This is an awesome question, and it almost doesn't even need an answer because it is true. Like it's shocking to me that everyone does get so upset about dilution, and exactly this reader points out, if they're doing something productive with it, and they're buying, let's say they're issuing shares to buy an asset that's going to earn more than what the current company is earning, then that is accretive to the shareholders, and everyone should be excited by that. And in the old days, you did see times when there was a deal that was deemed accretive and it would actually rally on the news. Nowadays, investing is more about squeezing the shorts and not actually allocating capital, to the best businesses, but where you can figure out how to make the most over the short run. And too often, the short run is basically just a function of how much demand and supply there is. So when they're trying to squeeze, shorts, or they're trying to push up a low float stock, actually issuing shares is bad. And that's why those people scream about it, because they're not really trying to have the interest of the company's long-term best interest in mind. What they're worried about is trying to, maximize their short-term gains.
Unless you're Hertz and you're doing that short.
And listen, a perfect example of this is AMC. And let's just contrast AMC versus GameStop. GameStop, until recently, didn't issue a single share. And AMC issued tons of shares and actually ensured the long-term viability of their company by issuing those shares. Anyways, the long and short of it is that, yes, you're not missing anything, dear listener. You're absolutely right, and the market has become kind of perverted in some way, and it's in a lot of ways like that. It's not functioning correctly.
All right, next question, Lena.
Next question. Howdy, folks. Patrick, do you have a favorite option spread strategy? And is there a spread strategy that doesn't get enough credit for how good it is? I found out about iron butterflies recently, and playing those during OPEX was quite the ride. Kevin, if you could change one thing about the markets, what would that be? Thank you all for a great show. It's a great way to start the weekend.
All right.
You want to go first?
Well, yeah. Well, first of all, like when I thought of the iron butterfly, I was originally thinking that 1968 band that you know which one I'm talking about.
Is there an iron butterfly band?
Yeah, there's an iron butterfly band that had like some like it was like one of those one hit. They're handsome looking fellows, aren't they? Anyway, so just to summarize, like an iron butterfly is basically a couple credit spreads, whether it's a condor butterfly is where the middle strikes are. But really, it's an idea that you're pinning where you believe the market will close. And when obviously what our listener here is referring to is that if you know there's a likelihood of a gamma pin where a certain strike price will drive the price to close close to it. Why not put on a couple credit spreads to maximize your profit of it closing within that pocket? And that strategy is effective. I mean, overall, what we've seen is that, I think Brent came on and did a great presentation. I don't know what the ratio is, but something like 10 out of 12 OPEXs end up closing right within the pins. And so it's one of those things where more often than not, it's actually a good strategy, but the times it doesn't work, it can be a wild ride. But the beautiful thing about it being credit spreads is you have a very defined risk. So I'm not opposed to that strategy. I tend to be directionally driven on my themes, and so I do a lot of option strategies forecasting the direction I think something will go. But certainly the iron butterfly is not a bad one, especially when you're focusing on the index that way. What's any comment?
Well, you didn't give us your favorite one, or it's like Sophie's Choice. You can't give your favorite choice. That's fine. Nothing wrong. With saying I love all my children equally.
You know what? Big picture trading, we do income writing, we do them all, and so it's sort of
they all have their place.
They all have their place. There's a right time. It's a right time for each. You know what's the best way? I'm gonna go on a little rant.
Cool.
Well, the way I like to look at option strategies is sort of like a carpenter's tool belt, and these are all different tools. And when you need to put in a nail, you pull out the hammer. And when you gotta put in a screw, you pull out the screwdriver. And you need you have all your tools in there. Each option strategy is something in your tool belt. And when the market reaches a certain point, there's a strategy that is ideal for capitalizing on it. To say that one strategy is better is saying that the hammer is better than the screwdriver. I mean, in the end, it's not. It's only when you need to use it, whether it's relevant, right? Is that a good way of giving an analogy?
But Patrick, when you're telling us about like using the tools properly, all I can think about is growing up, my dad loved vice grips. Like, my dad is just like the kind of guy, just get her done. Like, just get her done, right? So, honestly,
vice grips are good, though. Vice grips are good. Okay, so the vice, what is the vice grip strategy you're asking?
Okay, but just 1 second, I gotta tell you. So I go to shop class because I'm a little bit of a computer nerd, and my dad says no son of mine's not going to be able to change a spark plug. And back in the days when you change a spark plug, and so he sent me to auto shop class. I get there the first day, and the guy's like, does anyone know what this is? And he pulls up a vice grip, and I'm like, I know what that is. We use that all the time. So I put it in my hand and go, we use this all the time. That's a vice grip. And the guy looks at me, he says, he just like the disgust in his eyes, right? Like he's like, oh, and he's like, you will never be using this tool at my class ever, and if I catch you, you're gonna fail. Because basically the vice grip, is people use it for everything, and they should actually use the proper tool. And right. As the final aside to this story, I was absolutely useless at changing the spark plugs. And I stripped the spark plug on we had this like old
with a vice grip, right?
Well, I don't know. We had this. I stripped. My dad made me change the spark plugs. I went out, I did it, and I stripped it. And literally got out here, and he's like, "Oh God, what have you done now?" And he sees that it's stripped and shit. And most people would take it out and then rethread it and stuff. My dad looks at it and goes, "Oh, we're done." And he hammers it in there. And he hammers it in and says, "Don't ever touch this one again." Hope you're listening, Dad. Okay, I got a question I got to answer. Here we go. Kevin, if you could change one thing about the markets, what would that be? I get frustrated about markets being so short-term oriented. And this last listener that talked, highlighted how companies are not, doing accretive, issuance and then the market punishes them. That's what frustrates me. And especially in this current environment, I think that over the long run, the market does end up being an unbelievably great allocator of capital. However, over the short run, there are times that it just ends up being so stupid, and it just frustrates me that the masses and people end up being too short-term oriented, and therefore it doesn't do the proper job allocating capital that it should. And I know that kind of it's like it's a little bit. I can't remember who said it. Was it Winston Churchill who said, democracy is a terrible form of government. It just beats all the other, choices. And I kind of feel like that about markets. A lot of times they're not very great, but they sure beat everything else.
A lot of the
alternatives. I actually, we're talking a lot about, we're taking a lot of asides on this, and it's already a long show, so Lena's going to be mad at me, but I'm going to tell you one last aside. I believe it was the 1960s when the Soviet Union was still going, and they were having trouble pricing things. Like, they didn't know how to price different goods, like how do you price like a belt versus, wheat and stuff like that. They had trouble. And so they had tried to price it on their own, and it ended up causing shortages and all these things. So what they ended up doing was getting a Sears Roebuck catalog and basing their prices off of the U.S. things, because that was much more, the market of, bunch of different companies competing to create things was much better than them just obviously choosing singly. Okay, Lena, sorry about that. Go with the last one.
So the last question here, it starts off saying, insert fawning market huddle praise here in the hope that gets my question picked.
Well, that actually doesn't work. I don't know why we left that in. It's actually what works is definitely side effects. And I definitely I chose Aaron's today because he had 3 side effects. I was like, okay, I got 3 side effects done. So good side effects are the best things.
Locked out.
Okay.
Okay, so futures and options share some characteristics, namely big leverage and a fixed expiry date. I think of futures as options with an obligatory exercise and a daily gain and loss market to market. My stupid question, do futures contracts suffer from theta-like options? If not, why not? If yes, what is the interpretation of backwardation? Future negative skew exceeds theta?
Do you want to do this one, Patrick?
I'm going to take we'll split it up.
Okay.
Let me just kind of emphasize the key difference is that a futures contract is an agreement to do business into the future, but it still has an incredibly Delta One relationship.
Well, it is Delta One, but it's the obligation. Whereas
it is an obligation.
Whereas option is the right. And that's
no. But it's one side has the right, and the other has the obligation. Yes. And so the person that has the right is paying for the right, and the person who undertakes the obligation is being paid to take on the obligation.
It's really apples and oranges, though.
Yeah, they are very different products, and options have theta burn because of that rights and obligations relationship, while futures don't. But that doesn't mean the futures don't have other factors that create the skew and
not skew,
like whether backwardation.
It's carry. That's
carry.
The important part to realize is that the futures have a carry, and it has to do whether they're in contango or in backwardation.
Yes.
And if you want a great example of how that works, go to the show that Patrick cheats on me with. And who was the fellow, Patrick, that did?
Goldie Hansen?
Yes. And he was, what episode was that? Can you look that up quickly and we'll point them on the right way? But this fellow went about showing how the commodity index, the Bloomberg Commodity Index, I think is the one he used, although it might have been the CRB. At times it trades at backwardation, and at times it trades on contango. And when you looked at the total returns, you'll realize that, there we go. Lena says it's episode 261.
261.
So Macro Voices, for those who don't know, Macro Voices episode 261. He does a great job. Go grab the thing, and he shows you how it'll affect the total return based upon whether it's trading at backwardation or in contango. And that is important to note because a lot of times people look at the futures return and they just look at the price and they don't realize that there's a roll that's embedded in there. And I know Alex Gurevich would be often talking about this, about people looking at the futures, like the treasury bond futures, and looking at the price and thinking to themselves, oh, it actually hasn't done much. But meanwhile, there's a positive roll that has occurred over and over and over again. And this actually accounts for a large percentage of the gain if someone was to actually be invested in there. So it's very different. Right. It's the carry, and you could have positive or negative carry depending on the shape of the futures curve.
Right.
Agreed.
I think bottom line is that they're different products. One and options have the theta burn because of that relationship. The futures are simply discounting different carry costs of going in different points into the future. But really, in the end, it's still very delta one. When in regards to the behavior of those futures. All right, so let's leave it at that.
Lena?
So, Lena, where can they... Yeah.
If you have questions for Kevin and Patrick, please submit your questions to nostupidquestions@markethuddle.com.
There you go.
Okay.
Perfect.
So thanks for tuning into the Market Huddle. We appreciate you spending some time with us. Please give us a follow at the Market Huddle on Twitter. Lena's there every day. She always loves chatting with everybody. She gets tired of Patrick and myself. You can listen to Market Huddle on all the networks, Google Podcasts, Podbean, Spotify, Android Play, iTunes, YouTube, whatever. A lot of people watch on YouTube to see all of our charts and visuals. And while you're there, please like and subscribe to get our latest content. Smash the like button, as the kids say. Please rate and review us on iTunes. It's always fun to, see what people think. And actually, I don't have time to read one, but next time I'll make sure I find something good. Patrick, where can they find you?
All right, Kev, you can find me on Twitter at Patrick Ceresna, or you can find me at bigpicturetrading.com.
Speaking of bigpicturetrading.com, Patrick, I hear you're going to have something on the gold cycle. What do you got planned?
Well, Kev, I know that I wasn't just cherry picking your recent blog where you were getting bullish gold, but there's actually some cycle analysis that I do on gold and gold miners, and we're entering a stage where I typically get excited about things, and I am showing us a really interesting leap strategy on actually how to trade gold. So it's available for all members, including free trialers at bigpicturetrading.com. So you definitely check it out. So Kev, where can they find you?
I'm at Twitter at Kevin Muir, or you can check out my newsletter at themacrotourist.com. And listen, we can never have too many friends. Bear market, bull market. We're just happy to spend some time together on this crazy ride. So thanks for tuning in. Now stay around for the after show.
Well, there you go. Lena, hop on. That was a fun show.
It was fun. Sorry for making it long, Lena. I know.
We got to make up for last week.
I know. People are going to be like, God, it's...
I appreciated your Bill Gates rant there. That was pretty good.
You like that? Okay, let's do this beer. Because, God damn it, I like it. And
you didn't want to like it.
And it's a sour. And this is your palate is evolving.
Is it a sour?
Yeah, it's.
I don't know. Let's look this up.
In the description, I said it's sour.
Is it?
It's definitely a sour.
Oh, God, then
it definitely had a zing.
Something's happening to me then.
Patrick's rubbing off on you.
No, it's just his palate is evolving. He isn't drinking Labatt 50 anymore.
Exactly. Okay, so it is a sour. It's in the sour section, and God damn it, this is the best sour I've ever had. So
wow.
like if we were making sour kind of reviews, this would be the top by far. But this is like most sours that I kind of like. I go, well, that's drinkable, and then I go, it's a 6. But this thing, I'll go first. I'm going high. I really like this beer. I'm going 8.2.
What?
I liked it. I don't know what's going on. I don't understand it, but I don't care. I like it.
Wow.
All right, Lena, how about you?
I would give it a solid 7.6.
You know what? You stole my score, Lena. Okay. You know what? I want to do one better than you. That's the privilege of going last. I'm going to give it a 7.7, and I don't want to steal Kevin's thunder here. But you know what? It did freak me out a little bit when they say sunflower seed. I've heard of a whole bunch of different things in a sour beer, but sunflowers was not. It's like if I saw this on the shelf of a store, like that's not like the thing that's appealing to me. Where I'm, sunflower seeds. Let me try this, but it's good. I actually enjoyed this beer.
I'm with you. I love it. I literally go buy these things. Like these are good.
Wow.
Oh my
All right.
God, you're gonna have sours in your fridge. This is
Yeah.
like listeners. This is
Very this is unique
Newer
times.
listeners don't understand the significance of this moment in our market huddle
Yeah,
history.
Patrick, you're gonna have to go write in your diary.
Because like normally Kevin, when there's a sour beer, is a sub 5 because it doesn't even belong in the like normally even though we do a 1 out of 10 rating, we almost never go under 5. Like 5.
No, I go under
this
5
is
on a regular basis.
Yes, on sours.
No,
this is the whole point.
I know I go on other ones too.
No,
I get told
like
by
what?
millennials on Twitter all the time that I have terrible taste in beer.
No,
I'm
that
assuming
is
they're
true.
millennials. Because I think that the old guys all agree with me about these things, but I could be wrong. I'm making an assumption. But this is good. Anyways, I don't care. I call it as I taste it, and it's a good beer. I like it. I'm legit gonna buy some of these.
Oh,
There you go.
I like it.
there you go.
Okay, we got any good shows or anything to talk about?
Well, I have to admit that I crushed the season of Survivor.
Survivor.
Like, what the hell, right?
That's weird.
What season?
I think it was was it season 20 or I don't know.
my gosh.
It was. I did it. It was the one in the Philippines. I think it was. Anyway, but that's what I did, and I feel shame. I actually do. It's,
You watched the whole season.
But the problem is that once you get a few episodes in, you need to know who wins.
Oh.
So oh my God, it was really bad. I'm embarrassed. Okay, I'm not gonna speak anymore.
Yeah, that is really bad. I don't know. Like, what is it?
Is that show still on?
Is it 2006? Like, what the hell? Survivor?
Yeah.
It's still on.
Oh,
It's still
you mean
on?
this is like new?
No, this isn't the newest episode, but
But
they've
the
been
show is
going.
actually still on?
It just keeps
Oh,
going.
I don't like reality TV. I can't watch
Yeah,
a
I
single.
can't do it
I
either.
can't watch a single reality TV show.
Yeah, same.
Yeah. So
Can't do
I'm
reality
like,
TV. I watch TV to get away from my reality. Why am I watching somebody else's reality?
I don't know.
Doesn't
And they're
make
just
sense.
such idiots usually. Like, I don't know. Like, what do you call like the Last Gladiator? Like, when they get those guys to run through the maze, like, that when they're like getting pushed off and so that's if that's reality TV, I like that, but that's it. Do you know what Last Gladiator is?
Yeah, and I would never watch that. But I mean,
Isn't
then
that like
again,
an
I'm the one who
obstacle
did
course
watch
kind of
Survivor
thing?
here.
I
So
love
like,
The Last Gladiator.
I've lost my right to have an opinion after this. I shouldn't have said anything. No.
That's all right. You got to be honest. Just own it. Just say screw you. Like I like Survivor. What do
I'm
you
not
got
doing
about it?
anymore. Actually, after watching the entire season, I said that's the only season I'm ever watching. Like I'm done. I'm not going to go in.
Wow.
Anyway.
What about you, Lena?
I actually haven't really watched much because I've been busy.
Busy editing.
No, busy planning a wedding.
Oh yeah.
Yeah.
When's it gonna be? Well, listen.
I don't know yet.
Yeah, because we're under lockdown. For those who don't
Yeah,
know,
exactly.
Ontario has gone under lockdown. And so
Lockdown,
we're all
shutdown,
supposed to not
house
leave our home.
arrest.
We're not supposed to leave our
Wave
home.
3.
Yeah, so it's like
I'm going back to
Yeah.
Barbados. Fuck
it's,
this.
it's like you got to go for prison walks around your front yard. No,
Yeah,
you're allowed to go
so-
out and walk your dog and stuff. It's not as bad as Quebec.
Yeah, if you have a dog, you're
Yeah,
free to do whatever you want.
Shit, that's why there's no dogs in shelters anymore.
Yeah.
I was gonna go to Miami in June. I think I'm just gonna go now. I'm just not coming
Just
back.
stay there.
You know what though?
I'm probably gonna get vaccinated down there much quicker than I would up here
probably
anyway.
They will vaccinate you.
What?
They
Well,
will
that's-
vaccinate you. You
No,
can
right
go.
now,
You can
right
get
now
vaccinated.
they're discouraging vaccine tourism. Like
Vaccine tourism.
ma-
It's America.
Yeah,
You
that's-
can pay for anything.
Yeah.
That's true. It's true, actually.
It's like, yeah.
You probably,
You know, I still can't get vaccinated even if I want to. I don't meet the age group requirement.
well, here, but down there.
Exactly. My parents are like, "Oh, just come down to Georgia. We'll vaccinate you, no problem."
Yeah. It's great.
And I said,
It'll be
"Oh,
like
well, what
in a
what
back
about when I have
alley,
to-
but like,
Yeah, when I have to get back, I have to go into COVID jail. I don't want to do that.
it's COVID
Oh.
jail.
Well, you're already in COVID jail. It's a lockdown.
At least this is
I have
jail of my choice.
I have a buddy that came back and he went into his COVID jail, like the Holiday Inn, for a couple of days, and then he went home. And then they knock on your door nowadays. It's strict.
They came to his house.
Yeah, it's
And
strict.
saying-
well, that's
just to
because he
make sure
didn't
he's
pick
at
up his phone.
No, they're checking now. They're spot checking. They're finally, smartening up because it was people were just, woohoo. Woo! Party time.
I think some Eastern European old folks would say this reminds them of something,
Yes,
but
I
I'm not
agree.
going to go there.
Anyways, let's not talk politics like that. I am becoming a bachelor for the next month. My wife and son are headed off to pick up our daughters from Nova Scotia. So, actually, just one daughter because the other one's staying for the summer. But anyways, so I am a bachelor.
So what does that mean for
Nice.
you? What are you going to do?
I don't know. The only reason
He's going to roll up his sleeves and do some work.
yeah, because I don't work very hard.
What are you going to eat?
Listen, that is a huge problem, Lena. Like that is like, honest to goodness, I'm like,
What
what
are
the
you
hell am
going
I
to
gonna
eat?
do? I kind of feel bad for restaurants around me, and I feel like I should be supporting them in this time of need. I might just do a lot of takeout. I'll go.
Or just become a sandwich master. Like just like literally have an entire like sandwich.
I might
setup
just
and
go
you
buy like a bunch of meat and just barbecue continuously.
Oh my God, that
good,
sounds
actually.
heavenly.
Don't you think? Like just like buy a
that's
bunch
genius.
of steaks and like every night, or some chicken or some pork loin, nice pork loin.
You're gonna be hospitalized after a month of like.
Meat sweats.
Yeah.
Something like that. I don't know. Yeah, I don't know. But I am planning on watching Patrick's show.
What?
That show that you wanted to, that you loved, the cartoon. I've already decided.
yeah.
that's Archer. That is my goal for the month.
Yeah, it's good. It's good.
So I kind of figured. I was watching some sort of video, and the guy. Oh, I know what I was watching. I've become strangely obsessed with this video of this guy. He's called 7-4 Flight or something. Let me go find it for you, because this guy is a professional pilot, and basically all he does, here he is, 7-4 gear, okay?
Okay.
And what he does is he takes videos of, bad landings or, other things, or even sometimes he'll take videos of Hollywood movies, and he'll go through what's real, what's not real, or what the pilot did wrong, or stuff like that.
Oh,
And
okay,
it's fascinating. And I can't even remember why I told.
Where did you see this?
I don't know how. I went down the rabbit hole on YouTube. It's listen.
Has your wife left already? Is that why you went down the rabbit
Listen,
hole?
this is actually quite fascinating. Like, I didn't understand all the things about it, and it's like a behind the scenes kind of like how it really works, and it's really, honest to goodness, like if you want to waste an hour, just go and watch. Probably more than an hour. Just go watch this guy, and he even took the time. The scene from Madagascar when the penguins flew the plane.
Yeah.
He even took the time to analyze what was real, what was wrong on that.
In the animated cartoon,
Yeah.
like animated movie?
Yeah, but I really like it when the pilot's like bounce the plane and he goes, "Oh, that guy screwed this up. He pulled up on blah blah blah," and he talks about it all. I love it. Or when the guy,
Does he analyze the original Airplane movie?
no,
from,
he
like,
should. I should check out if he does that. Or
Because that is classic,
yeah,
right? Like
he did shit all over the Air Canada pilots that almost landed on the in San Francisco. There was almost a huge accident, and it probably didn't get a lot of press, but here in Canada it got a ton of press. Was Air Canada pilots were going into San Francisco, and they talking to the tower, and they're like, "Hey, we see some people on the runway," and tower says, "Nobody's on the runway," and they come down, and they're like whatever the side runway is, like where they all wait to take off. Like whatever that thing, the taxi
waiting
runway
for the
or whatever it
tarmac,
is.
whatever, yeah,
He
yeah.
basically, this Air Canada pilot almost landed on there and then had to pull up. And this United pilot's like, "Holy shit, Air Canada's right above us," and blah, blah, blah. Like they almost killed thousands of people with
my
this
goodness.
thing. So he goes through like how it happened and what they did wrong and stuff. Anyways, fascinating stuff.
But they didn't analyze the Airplane movie. Like,
Well,
come
I don't
on.
know. Let me just go look at this thing. I'll Google it right now. 7-4 gear. 7-4 gear. And then Airplane movie. Let's see. Oh, airline movie. Oh, no, I don't think that's it.
I don't think he did it yet.
Yeah, that's a
You should
problem.
suggest it, submit it, and say, "Hey, can you do an analysis?"
I
on
should. I'm gonna-
Airplane
You know what?
movie?"
I haven't seen that Airplane movie for probably 15 years. Like I watched it once again, like in the 2000s.
Is he
but-
still alive? What's his name? Leslie.
Lloyd Bridges, or which one? Or Robert Hayes?
Isn't which one?
The main character that played Ted Stryker.
I'm
Patrick?
My God, I can't remember. I remember
yeah, I know.
that name.
You're really, Patrick, you're really a little bit.
I just Googled it, I won't lie.
Oh, okay.
I was pretending like I really remembered. I didn't. But that was a great movie.
Yeah, it is great. I like the guy who says I picked the wrong week to give up sniffing glue. Anyways, that's what I've been doing. If you're bored, go check it out. 7-4 Gear. It's pretty funny.
I gotta put it out there. We're looking for wedding officiants
What does that
in
mean?
GTA. Somebody to marry us because it's like last minute and it's COVID.
Oh.
So if there's any wedding officiants out there in the Huddler group,
Okay, listen.
let me know.
Lena, I haven't told you this, but I am a minister
Are you really?
of the Church of Flying Spaghetti.
Flying Spaghetti Monster.
Flying Spaghetti Monster. That's it. Yeah, yeah.
Why did I fall for this?
No, it's like, but you think I'm kidding. I am.
Are you really?
He is
Do
officially.
you
Yeah.
have like a certificate
Yeah.
you can show me?
Oh,
I
yeah.
don't know if I can wedge you. Do you know who
well,
the you know the story about the Church of Flying Spaghetti Monster?
No.
It's this like teacher that got upset, a science teacher.
Oh, with the ID picture or whatever.
He got
Is
upset that he had to teach, like he was a science teacher, and he got upset he had to teach religion. So he said, like, you know, he took a cauldron and put it on his hat and on his head, and
that's how
then
it
made
all
this whole
started.
thing, and it's pretty awesome. And you can get ordained as a minister, and
And you did.
yeah, me and my buddy, we did it, you know, just in case we had to marry somebody.
You should find out if you can marry.
You know what,
someone.
this-
It's like literally just a joke, but anyways, I am a minister in this church.
You know what? I now is it still available? Like I feel like left out.
Oh, you should do it for sure. Well, I know what I'm getting you for Christmas.
Well, thank you. Though, if you have the ability to marry people, then that's like a bonus.
Yeah,
right?
I don't
Like,
think you really do. I think you just have a
But I mean, if it's a real religion,
I don't know if it's a real religion.
I'm pretty sure you still
Well, then
have
how
to
can you
get
be
like
ordained a
certified.
minister?
I'm
Okay.
kind of
Somehow.
I'm saying a minister in this church. I don't think it's like
Recognized legally.
yeah, like next.
do you get tax credits?
No, Nexism or whatever it is that Canadian or it wasn't Canadian, but there was that cult. They thought they were a religion too. Oh, and like
yeah,
not
I
only
heard
that,
about
like
this.
isn't Scientology? They do it as well. Like that's the whole thing, right? They consider themselves a religion, so they don't have to
Wow.
pay tax.
We talked about a little bit of politics, a little bit.
Yeah,
of
well, we'll
religion
just
before
throw it
we
in
gotta
there.
sign
Well,
off.
listen, I don't know how many Scientologists are.
You're the one who brought up marriage.
You know what? Yeah, well, that's even worse. I don't know how many Scientologists listen to us, so if I'm going to pick a group to kind of, you know, shit all over, I'm pretty safe, I think, on the Scientology group.
No, watch the hate mail come pouring in.
If you're a
I dare our listeners to pretend they're offended. Just
no,
start
don't pretend
bombarding.
you're offended. But if you're a legitimate Scientology member and you listen to the Huddle, hats off to you.
Yeah, thank you.
You know, we welcome all faiths. We Scientology included, or
right.
Church of the Flying Spaghetti Monster. We do not discriminate. Everyone is included. I don't pretend to tell anyone else how to live their lives. Anyways, on that great note, Lena, I hope you find it efficient.
I really hope so too.
Yeah. So
With
are you
COVID,
wanting
I
to
don't
do
know
it
how
like
this
this?
is
Sounds like
gonna
it's
work.
soon. Like
Well, I'm not getting. Well, full disclosure, it's my birthday on Monday, so I'm not getting any younger. So we want to try to hitch before I get too old.
because
Because if you pass one more year, you can't do it anymore.
No, it's because you only age on the year you turn the actual your birthday. It's not linear. It's like
Oh, it's not.
Yeah.
There's a curve to
well,
this.
not a curve. It's stair step. You age only in that 1 year. You know, the whole year and a day, according to Lena.
That's right. So that's why we're in a hurry.
Oh,
We're
well.
not getting any younger.
I hope you-
so.
My birthday is a week from now. So
Oh my God, you
we're
two
not
are
that- we're
very
stones-
like
yeah.
you guys are right on top of
Stones
each
throw
other.
Yeah.
Yeah.
Everyone give a big shout out to Lena and Patrick next week.
Okay.
You know what I always say
Exactly.
about birthdays? They suck, but they sure beat the alternative.
The big sleep.
Yeah, the big sleep.
But today is a very happy unbirthday to all of us, right? Oh my God, I didn't believe I said that.
Okay.
Here we go.
Are we,
So
gonna talk about what we were gonna talk about?
Sure, tell us what we're going to
Yeah.
talk about.
So we had a listener submit
Oh, yeah.
their version of a WTF clip that we are going to add in our YouTube video. It doesn't translate very well if you're just listening to our podcast.
To the podcast.
Right, because there's a lot of visuals.
That's right.
Right.
So you may have to visit our YouTube channel to check it out.
Right. And so we appreciate, why don't you tell us who the listener is, and we do thank him for all his time.
Pull that up now.
Yeah. And we're gonna include.
It's a long one, so
It's a long one. It's 5 minutes long. So we're gonna stick it on at the end of the YouTube show, but we're gonna on the audio version. Lena's got a little extra work. She's gonna not have it because it's too much visuals.
Yeah. So this is from a listener named Rob Smith. Thank you so much for submitting your clip. We thoroughly enjoyed it, and we would love for everybody to check it out.
That's awesome.
All right.
Thanks, Rob.
All right.
Okay, well, everyone have a great week. Lena, have a happy birthday.
When happy birthday, and when are you a bachelor? As of this
tomorrow,
weekend?
Yeah.
Oh my God.
You might have to bring him some food if you can.
No, I'll be okay. I gotta figure out. I'm technically not a bachelor. It's myself, the dog, and the cat. So I'm in charge.
You could
Lena, my
always
cat, it did something dumb, and it's like licked itself, has no hair on a certain spot, and so we took it to the vet, and it's got to wear a stupid helmet, the cone,
because it licked itself too hard.
Yeah, Patrick. And
learn behavior.
So now I gotta I got the cat with the cone, which is annoying because it can't eat very well, and it's all pissed and wandering around, meowing and stuff.
Tell me you didn't pay $1,000 for the vet to do that.
No, they just don't actually. They just give you this thing and they tell you to wear it. And so my wife's trying to figure out if she can get one for me with my phone. Okay, on that note, happy birthday, guys. Thanks for tuning in, everyone. See you next week.
Have a good weekend.
See you.
Bye-bye.
What do you think about is your calling? There are three things that we're trying to do well, and if you want to use the word calling, that's great. Be a great investor, excellent, and we see how God is leading the whole world, and human race through these companies.
See, Ned was right. Violence is killing this sport, it's dragging it through the mud. If things keep up the way they are, hockey players will be nothing but actors, punks.
As an investor in these companies that are advancing human society, I think God loves it.
When I want to play it straight, no more nail him, no more fuck with him, that's finished. I want to win that championship tonight, but I want to win it clean. Old-time hockey. Like when I got started, Geez, Toe Blake, Dick Clapper, Eddie Shore, those guys were the greats.
We were a big investor in a company called LinkedIn. What is LinkedIn? LinkedIn is about helping people realize their job potential.
Hey, guys. Let's get some speed out there. Keep your eyes open. Better passing. We got a big trade coming up out there. Mother of God. Oh, a big rally is period. A big rally.
We're losing!
Teamwork, guys. More teamwork.
They're burying us alive!
Eddie Shore?
Oh, piss on Eddie Shore.
Old-time hockey?
Piss on old-time hockey. You're blowing it. Boys, every scout in the NHL is out there tonight with contracts in their pocket, and they're looking for talent.
We don't invest just to make them Christians.
They come here tonight to scout the Chiefs, the toughest team in the Federal League. Not this bunch of pussies.
Scouts? Okay, guys. Show us what you got.
The key question really is if the same people that stopped you in the street to harass you about Viacom doing badly, do they now stop you and pat you on the back because it is up an astonishing 500% over 12 months?
Guys, we all know how to play hockey. Just play it smart. That's right. You're not daring. Stick 'em. Fuck 'em. Christ, pop 'em. Sure, let's go. Come on. Let's go now. We need this win, you know. We got a lot of losses.
Yeah, we got a lot of losses.
Come on. That's what we're here for, guys, to win.
So that's VIP Shop. So today it was up 2.3%. For the week, it was up 9%. And then for the month, 12%. And for the year, 96%.
For Tencent, the fintech is another driver, so which is less impacted by the whole competitive landscape.
Right.
So I think in general that's true that three internet companies are seeing competition, but Meituan seems that has the best performance in terms of this competitive landscape.
Broome County is just visibly upset by this display.
Wells Fargo was selling off some of Nomura's stock. We haven't seen Credit Suisse in the market. We heard overnight, as you know, that Mitsubishi USJ is facing loss of $300 million, not tied directly by the bank, at least, to Bill Huang, but it's quite possible that they, too, are sitting on unsold stock. In some, Fran, there are potentially billions, maybe more than $10 billion of Bill Huang's highly levered positions yet to hit the market.
What was happening last week was you saw some of the big Chinese names that Bill Huang had been in falling precipitously. By midweek, you had the Viacom situation, which was also something they owned, and obviously Discovery. Now, interestingly, some of the banks, including Goldman, contractually have to give their clients time. In fact, they had what was called a margin account, and that meant that they would have to get a 24 hours notice, effectively, to, quote, cure the problem. That's what would happen. They'd have to cure the problem. However, Morgan Stanley and Credit Suisse, the way their accounts are set up are different. They can actually almost unilaterally call a default, if you will. Banks like Goldman Sachs and others who wanted to get out, who couldn't effectively or couldn't press the button to say go, they actually had to wait for Credit Suisse and Morgan Stanley to go first.